And, now there's a big debate at the Fed is like, can this continue, or do we need to see some pain to get back to 2% inflation? And that's going to be the big debate when the Fed starts meeting. Today, among other things, today is the last day we get Fed speak before the July meeting, and then we go into a self-imposed blackout. So,
right.
It'll be an interesting debate.
And Steve, we only have about 30 seconds left, but you brought up James Bullard, who's set to leave the central bank. How tricky is this for the Fed's trajectory moving forward when you have a hawk like that who's about to leave?
Yeah, I mean, I think in the short term, Bullard's highly influential. He definitely carried more than his single vote because everybody paid attention to him, including the markets. But Powell has firm control on the committee. So if he wants to hike, he clearly wants to hike in July. Whether we get a second hike or not will be basically up to Powell. He can continue to do it if he wants.
All right, Steve Matthews, economy reporter at Bloomberg News. Always a pleasure getting your take on all things when it comes to the trajectory of economic growth. Want to get a quick check on the markets, looking at the S&P 500, still higher, and looking at healthcare up more than 1%, leading that index higher, followed by technology up about 1.2%. We'll have more coming up. This is Bloomberg. Now let's get some company news with Bloomberg's Steve Rappaport.
Good morning and happy Friday. Second quarter bank earnings are rolling in, and they're broadly underscoring the economy's resilience. More from Bloomberg's Charlie Pellet.
Steve, J.P. Morgan Chase's revenue soared to a record in the second quarter, boosted by the Federal Reserve's interest rate increases and its acquisition of First Republic Bank. Citigroup, the world's second-largest credit card issuer, is reaping gains as customers borrow more, even as a growing number struggle to make payments. And Wells Fargo earned more net interest income than analysts expected in the second quarter, and it lifted its guidance for the full year as big American banks continue to benefit from the Federal Reserve's rate increases. Steve?
Thanks, Charlie. J.P. Morgan Chase stock up more than 1%. Wells Fargo up more than 0.25%. Citigroup down more than 1%. No lights, no camera, no action. Bloomberg's Steve Potus has more on the Hollywood strike.
For the first time in 6 decades, Hollywood writers and actors are on strike at the same time. The Screen Actors Guild walked off the job at midnight after failing to reach a new labor agreement with the Alliance of Motion Picture and Television Producers, which represents studios. While the Alliance says it offered double-digit pay hikes and higher pension and health benefits, the union says the sides remain far apart on compensation from streaming. In addition to walking off the set, actors will also have to stop attending film premieres, award shows, and other events.
Thanks, Steve. And Nissan recalls about 1.4 million vehicles for a number of issues, including unintended acceleration and short circuits that could cause motors to stop while driving. I'm Steve Rappaport, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:21 on Wall Street. We check the markets all day long for you here at Bloomberg. Stocks are broadly higher. We do have a higher than expected report on consumer confidence. This is at University of Michigan number. The preliminary July consumer sentiment number coming in way higher than expected, 72.6. The estimate was just 65.5, so that is a huge beat. And that consumer sentiment number, also it's worth noting, at the highest level now since back in September of 2021. We also have a bunch of bank earnings we've been talking about. We're going to hear more in just a couple of minutes from Bloomberg Intelligence and Allison Williams, but those bank earnings did broadly beat, including some big ones. That's contributing to the overall positive tone, we'll say. The Dow up 140 points. That's about 0.4%. The S&P 500 up 14, about 0.3%. The NASDAQ, it is up 82 points now, and that's about 0.6%. And Ken Leon, Director of Equity Search at CFRA, says the bank results are broadly positive.
This was a good quarter. We thought this would be the trough of the investment banking cycle, and we are seeing green shoots, but the strength of the consumer and commercial loan activity is very promising.
Very promising. And Leon there on the Bloomberg Surveillance podcast, JP Morgan Chase shares, they are up about 1.5%. Citigroup, though, it is down more than 1%, of almost 1.4% now. Credit card biz doing well, but borrowers struggling. We're going to talk more on that in just a minute on why it's down. Wells Fargo shares, they are higher. The yield on the 10-year right now, 3.8%. NYMEX crude, it is down 0.8%, 76.06 a barrel. Spot gold, it's down almost 7% at 19,053. And that is a Bloomberg Business Flash.
Thank you, Denise. We appreciate it. Jess Minton and Simone Foxman here in the Bloomberg Interactive Brokers studio. And on a day when you're looking at these bank earnings, JP Morgan, Wells Fargo, Citigroup all reporting this morning, especially if you're looking at JP Morgan, revenue soaring to a record, really boosted by Fed interest rate hikes. And also looking over at Wells Fargo, those earning more net interest income than analysts did expect, and really helping giving a boost to the broader equity market this Friday. But who better to come in and speak with us and break down these latest earnings results from the big banks than Allison Williams, Senior Global Banks and Asset Manager Analyst with Bloomberg Intelligence. Thanks so much for joining us in studio, Allison. What's your takeaway once we got these first batch of big banks this morning?
So I would say, obviously, the net interest income upside at all the banks and the higher guidance, especially with respect to net interest income, is positive. But I think it was sort of expected by investors. When you looked at the run rate for these banks, you could tell that their previous guidance was a little bit conservative. I think the most impressive thing that we saw this morning was the 25% return on tangible equity at JP Morgan. So that is helped by the net interest income, also helped by the better capital markets business, costs in line, and provisions rising as we would expect with normalizing credit. And so across the banks, we're seeing, trading down a little bit, but still normalizing within historically higher levels. Fees, M&A is really the big headwind there as expected. Equity fees up a bit. We're seeing some green shoots there, but we still expect that fees are setting at a lower level. Expenses basically in line where, there is some higher severance adding to those costs, especially flagged by Wells Fargo. And then on the provision side, we are seeing reserve building. Again, Wells Fargo, which is the biggest commercial real estate lender, adding related to office properties. That's not a surprise. It's an area that everyone's watching. And then that card growth really that we're seeing in the loans also means that banks are adding reserves.
Well, we'll dig into some of the details there, but as someone who is not as enmeshed in the banking nitty-gritty. No, I think it's not something that's particularly fantastic as a finance reporter. However, I want you to differentiate for me between JP Morgan, whose shares up percent today, Citigroup down over 1%, and Wells Fargo somewhere in between. I mean, is that the ranking that we're seeing in terms of who's best, who's worst in our earnings report out today?
Yeah, so I would say J.P. Morgan again having the strongest quarter, and they're in their best position for the long term, right? So they've been in this virtuous cycle of spending on technology, that technology benefiting them with a competitive advantage, especially in business like deposit gathering and the global investment banking business. With regard to Citigroup, Jane Fraser really, I think, making all the right decisions there, but that's really a longer term story. I mean, that bank has been, trying to sort of revitalize itself and fix some things for a significant period of time. One thing that they have in common, Wells Fargo, is that they're spending a lot of money on the regulatory and compliance side just to get things in order. And so Citigroup probably has the most opportunity for improvement. I think they're delivering on everything that Jane has said. It's just a longer path. With Wells Fargo, so again, I talked about the regulatory side of things and those costs, but I think hopefully for Wells Fargo getting to the end of that journey. It's been certainly much longer than people have thought. But again, better net interest income. Card is a much smaller business for them, but that's been a business that they're investing in, and that's been paying off. Commercial real estate, as I said, they're the biggest lender there. So I think it's prudent that they're taking provisions related to the office, even though that's going to be a long story.
Allison, I wanted to get your thoughts when it comes to banking regulation, because we did hear from Fed Vice Chair Michael Barr, as you know, earlier this week, talking about how there could be these potential regulatory changes. And on JP Morgan's call this morning, Jeremy Barnum, the CFO at the bank, did receive a question about Basel III, asking about what kind of market consequences. And CEO Jamie Dimon was actually warning about in his intro when he cited that these upcoming finalized rules, Barnum actually did call some of the proposals, quote, excessive. So, I mean, do you think regulators are listening? And what is your kind of view of how the banks are thinking about these potential proposals?
So I would say two things. So first of all, I mean, the proposals are a long time in coming. I think investors, managements, we all want to know what the rules are, so we can sort of, get on with understanding what the final end game will be, and that's sort of what they're called, the Basel III endgame rules. That being said, we still have sort of this volatility of the ongoing stress test, so that creates a lot of noise. But the second thing, again, you'll hear from bank managements and I think bank investors is, the rules are designed to make banks safe, but what are the unintended consequences? How much lending is being pushed out of the system? It's no secret that private credit is really one of the fastest growing areas of asset management. Alternative managers are focusing on this area of the business. Traditional managers are buying into the business. And to the extent that this credit lending is being pushed outside of the banking system, the risks don't go away. I guess it's where those risks are.
Speaking of risks, one of them earlier this year was from that regional banking crisis, perhaps, though it does seem to have dissipated to some degree. JP Morgan seeing a $2.7 billion gain in its First Republic purchase. What signals is some of the commentary that we've heard from these executives this morning sending about other banks, regional banks that are looking to report next week? Are there still concerns alive and well in that space, or have we gotten past that?
I would say, if anything, perhaps the fears might be quelled a bit. There is, certainly a differential between some of these big banks and some of the regional banks. But I think in general, what we saw, even as early as April and with the first quarter result reporting season, we did hear most bank management saying things had stabilized. And so we have seen that this quarter. As the turmoil sort of subsided and deposits subsided, investors obviously have focused on the cost of deposits. Those are rising, but again, I think a little bit better than feared that we've seen at the big banks. I think one differentiator that we might see, a key one for these big banks versus the regional banks, is more on the loan side of things, because credit card is really a much bigger exposure for Citigroup, JP Morgan, Wells Fargo to a lesser extent, but still more than some of these regional banks. And what we are seeing is weakness in commercial and industrial balances. loan balances. We saw that in the Fed industry data, and we're seeing it at the banks, and that may weigh a little bit more on the regionals. And I think, from a broader perspective, back to your point about the bank turmoil, is we will be watching deposits. Are these bigger banks continuing to benefit, or have things pretty much stabilized for everyone? My guess is it's probably more of the latter.
And for the bigger banks next week, we have Goldman, obviously Morgan Stanley, Bank of America. We only have about 30 seconds left, but what's the big thing you want to watch when it comes to those particular banks?
For Bank of America, pretty much the highlights I've hit. How is net interest income holding up? Their cost of deposits, and C&I balances, but they might get some benefit from card. Goldman and Morgan Stanley, we're really going to see the M&A weakness feed into those results on a negative way. We'll be looking for the equity green shoots. We'll be looking to see what happened with headcount and severance costs as that sort of looks to the second half. And then, Goldman Sachs has a few specific things that are going to damp their results, but we'll be looking at their trading to see how that share holds up. And then Morgan Stanley will be looking at the wealth business, how the flows look. There's some seasonal issues, but hopefully improved from there.
Great. Well, Allison Williams, Senior Global Banks and Asset Manager Analyst with Bloomberg Intelligence. Always a pleasure having you join us. Thanks so much. And now let's head down to Washington, D.C. for world and national news with Bloomberg's Nathan Hager.
Okay, Jess, thank you. It could be the break police have been looking for in the search for a serial killer on New York's Long Island. A suspect is under arrest in the Gilgo Beach murders, the deaths of 11 people whose remains were found in 2010 and 11 have long stumped investigators. Most of the victims were young women who had been sex workers. Multiple reports say the suspect was taken into custody last night in Massapequa. The New York Post reports that suspect will appear in court later today. Trading their lines for picket signs, Hollywood actors have joined screenwriters on strike for the first time in decades. Bloomberg's Ed Ludlow has more from the Sun Valley Conference in Idaho, where a number of studio executives are taking part, and the strike is the talk of the event.
We've gone from one extreme where we're like, how will these streaming companies ever be profitable, to kicking down the door because we're worried that the next season of our favorite shows aren't going to be on schedule.
Bloomberg's Ed Ludlow reports the actors and writers are fighting for higher pay and more protections from artificial intelligence. The House is set for a final vote today on the annual defense policy bill, but passage is in doubt. Conservative Republicans tacked on several amendments last night related to abortion rights, transgender health, and military diversity. Bloomberg government's Zach Cohen has more.
This bill has passed for over 60 years in a row in Congress. It's usually bipartisan, getting wide support from both Democrats and Republicans, mostly because it includes, pay raises for troops, but also it sets military policy.
Now Bloomberg government Zach Cohen reports Democrats are lining up against the bill. President Biden just announced a second quarter fundraising in the 2024 race. The Biden campaign says it raised more than $72 million along with the Democratic National Committee. That's more than former President Trump and the other Republicans combined, but the New York Times reports it is well short of the $105 million then President Trump raised for his re-election during the same quarter 4 years ago. Global news powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:40 on Wall Street. We check the markets all day long for you here at Bloomberg, and stocks are higher. We are off session highs, but we did have that Michigan preliminary July consumer confidence number blowing everything out of the water, coming in way higher than expected. That number, that's the July preliminary number, 72.6. The estimate had been for 65.5, so that's quite a beat. And that consumer sentiment for July from the University of Michigan, that is the highest since September of 2021. So that's also a big notable. We have a bunch of bank earnings. They beat, including some big ones, and that was contributing to the positive tone. There is a lot of positivity, even though we are seeing things kind of wane a bit. And Stephen Auth, Equities Chief Investment Officer at Federated Hermes, he calls for stocks to go higher, way higher, on what he's saying will be a broad-based rally.
Because there's so many people that have been on the sidelines and are now going to come in, and we think they're going to chase the laggards here.
And off there on Bloomberg Surveillance Podcast, the Dow, it is up 76 points now. The S&P 500, it's also up just about 4 points now. Just call it 0.1%. The NASDAQ is up about 40 points now, and that's about 0.3%, so not as higher as we were before. And one of the reasons maybe we're kind of seeing some changes in what we're seeing with the bank stocks. JP Morgan Chase shares, they're up, but just slightly. They were up significantly earlier. Citigroup shares, they are lower now. The credit card business doing well, but borrowers are struggling. In Wells Fargo, it is now it's been fluctuating between positive and negative, now lower. The yield on the 10-year Treasury, 3.78%. We were looking at 3.8% earlier. NYMEX crude, it is down 1.3%, 75.59 a barrel. Spot gold, it is 19.56 an ounce. That's about 4% lower, so gold taking quite a hit. And it looks like there is no business like show business for French billionaire Francois-Henri Pinault. We are hearing the luxury tycoon is in advanced talks to buy a majority stake in creative artists agency. One source says the talent agency, backed by private equity firm TPG, could fetch a valuation, guys, of at least $7 billion. CAA, you know, it's really long been one of the premier power brokers in Hollywood. And I should also mention the firm's site, by the way, offers information on how to book Salma Hayek. And that's Pinault's wife, actually, which I didn't know.
He has an inside
as a
track.
speaker, but I guess he, had the inside track there. He married up. And that's a Bloomberg Business Flash, guys.
Thank you, Denise Pellegrini, for one of the greatest business flashes I think I've ever heard just now. Jess Smitten and Simone Foxman here in the Bloomberg Interactive Broker Studio. We're going to change things up next and talk about student loan forgiveness. And we're going to have Janet Lauren, higher education finance reporter here with Bloomberg News, joining us on Zoom to talk about this. And especially looking at the Biden administration set to forgive $39 billion in student debt. This does come after the Supreme Court did strike down that broader debt forgiveness plan. So talk to us, Janet, about this and kind of break it down. What's the latest on this news here?
Great. Hi, thanks for having me. So this is a little bit different than the what was being proposed that the Supreme Court shut down. This was sort of administrative changes to a longstanding program called these are all income-based repayment programs. And it targets borrowers who are having trouble paying off their loans. And the issue here is, you know, if you look at these income-based repayment programs, they're kind of confusing. There's a lot of red tape. You have to show you've made payments. And this was, in some ways, a little bit of a surgical strike, updating more of a technical requirement. And it affects quite a high number of borrowers, more than 800,000, and and it forgives 39 billion in student loans. But this isn't an automatic forgiveness. These borrowers have been making payments for quite a long time.
Tell me about the impact of this in comparison to the broader plan that the Biden administration had tried to push through. Give me a sense of scale.
So the whole federal student loan program, we're talking about roughly $1.7 trillion. And that impacts everybody for decades who've been borrowing student loans. It also includes parents who've taken out Parent Plus loans. And that forgiveness would have given $10,000 to borrowers, $20,000 if you had a Pell Grant, which is aimed at low-income students during college. And that was a one-time forgiveness. And critics, said, perhaps it's unfair to people who've already paid back their loans, but it also doesn't really fix the overall problem of college costs continuing to go up and up and up. And this sort of a surgical strike really addresses a program that borrowers have been making payments for. And there's a bunch of income-driven repayment programs. I think there maybe is as many as a half a dozen, and they're confusing. And and this allows payments that people have made to count towards these forgiveness, which is 20 or 25 years. And these income-driven payments are calculated based on your income. You have to reapply every year. You may not be paying anything. And as students start to think about repayment, which begins October 1st, they may want to learn more about these programs to see if they're eligible, that they may not have to make any payment at all when the repayment plan starts in October.
All right, Janet, so myself, along with millions of others who have a student debt here, if we want to figure out how we qualify, especially when it comes to a lot of these income-driven repayment plans that you're walking us through, what's the best way to figure it out? Just call up your servicer?
Well, great question. So the servicers are the ones that are going to be getting information about repayment. However, you could actually go right now to FSA, Federal Student Aid, and log on and go through the whole website and figure out what you might qualify for. There's a lot of information you could do now before you even hear from your servicer. So that's what I would recommend, because the plans are kind of complicated.
They are.
And borrowers just may get a big headache trying to understand it. But at least go through there, look at the website, look at the plans. And if you've never, there's something like 7 or 8 million people who've actually never made a payment because they've graduated from college in the last 3.5 years. Go into the student loan site, register, get more information so you know exactly what you have. It's, if you're taking out a loan every year in college, you have chances are 8 loans. They may all have different interest rates, and it's quite confusing to keep track of everything.
Who do you think gets left out of this?
Well, this particular program is for people who have already left, who've been already in these income-driven payment programs. So they're aimed at struggling borrowers, people who maybe are underpaid, they haven't had jobs, and that's who these are aimed towards. It's all going to depend again on your income, and if you sign up and just look at the department pages, you'll get a better sense of who these are targeted for.
Janet, talk to me about how this fits into the overall Biden administration plan looking forward about trying to forgive student debt. Are we going to see more piecemeal sort of developments at this after that unfavorable Supreme Court ruling? Or will we see, is this just preparing us for a bigger push?
Well, yes, you absolutely are going to see more of these, because there are ways to sort of look at these programs in particular. In the press release that the Biden administration sent out earlier today, they talked about forgiveness that borrowers have already received, such as $45 billion through people who work through the Public Service Loan Forgiveness Program. That's a program where you make payments for 10 years and you work in public service or a nonprofit, and you get forgiveness after 10 years. But again, this has been a really complicated program. They've made a lot of changes to make it easier. I think before these changes, something like the number of people who got forgiveness were extremely low, because it's, again, the key word is it becomes very confusing. If you switch jobs and you haven't signed up and you haven't, made all the changes, or your employer hasn't, you may not qualify. And then they also forgiven $22 billion for more than 1 million borrowers who were, cheated by schools or their schools closed. And these are typically for-profit colleges. And then you add these $39 billion, and it's not a small amount of money for loan forgiveness.
Yeah.
I think.
Well, Thanks so much for joining us. Janet Lauren, higher education finance reporter with Bloomberg News, joining us to talk about President Biden today announcing this another move when it comes to forgive student loan forgiveness. This is Bloomberg. Now let's get some company news with Bloomberg's Steve Rappaport.
Good morning. It's a big day for big banks. JP Morgan, Wells Fargo, and Citigroup beating second quarter revenue estimates thanks to higher interest rates. Bloomberg's Abigail Doolittle with more.
For JP Morgan, record revenues of $41.3 billion, their net interest income at an all-time high, and those rising rates helping, not hurting as had been feared. Wells Fargo also net interest income strong. They lifted that guide. The deposit costs up more than 1%, but still the stock is higher. And Citigroup, the second biggest credit card provider, well, an 11% jump on personal spending. The FICC trading solid.
Thanks, Abigail. Shares of JP Morgan currently up less than 1%. Wells Fargo up less than 0.25%, while Citigroup is down a little more than 1%. We have Microsoft and Activision Blizzard thinking about making tweaks to their cloud gaming business in the UK in order to win over regulators there. Let's get the latest on that from Bloomberg's Joan Doniger.
Steve, sources tell us Microsoft and Activision are considering giving up some control of their cloud gaming business to appease regulators ahead of Monday's deadline to seal the $69 billion deal. That could involve selling off the cloud market rights from games in the UK. The European Union approved what would be the largest merger in the video game industry, but US and UK regulators oppose the plan because of antitrust concerns.
Thanks, Joan. Microsoft shares and Activision Blizzard stock also up. And Walgreens will offer Perrigo's over-the-counter birth control Opal. The drugstore chain says it will start to sell the newly approved OTC pill in the U.S. once it is commercially available. No word yet on the price. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Jess Mitten and Simone Foxman here in the Bloomberg Interactive Broker Studio, taking a quick check at the markets here. S&P 500 up about 0.1%. Dow Jones Industrial Average up about 0.3%. You want to look at the NASDAQ 100 up about 0.2%. So paring back from those intraday highs, looking at healthcare leading gains, but you want to look at a weekly basis. The S&P 500 is still higher, up about 3.5%. And before we get to more, let's get a check on world and national news with Nathan Hager.
Jess, a suspect is under arrest in a string of murders on Long Island that has stumped detectives for more than a decade. Bloomberg's Kimberly Adams reports from New York.
He's reportedly being looked at in connection to the murders of 4 women whose remains were found near Gilgo Beach in 2010. Fears about a serial killer on Long Island have gripped the New York area since the so-called Gilgo 4 were discovered after police began investigating the disappearance of Shannon Gilbert in May of 2010. Several more sets of remains were discovered in 2011, including the body of a toddler, as well as those of Gilbert. Kimberly Adams, Bloomberg Radio.
Thank you, Kim. Meantime, the New York Post is reporting the suspect has been identified as Rex Heuermann, the founder of Manhattan architecture firm RH Consultants and Associates. Again, that suspect is set to appear in court this afternoon. The Suffolk County District Attorney has set a news conference for 4 p.m. Wall Street time. The White House says President Biden will not sign a bill that affects military readiness in a negative way. That's what we heard this morning from National Security Spokesman John Kirby on CNN. When asked about amendments to the annual defense policy bill, conservative Republicans tacked on bans on the Pentagon paying for service members' travel for abortions, transgender health care, and diversity initiatives. The House is debating that bill right now. It could vote on it later today. Final passage is in doubt. The world has added 165 million more poor people as governments rack up more debt. We get that story from Bloomberg's Amy Morris in Washington.
Some of the world's poorest countries borrowed heavily since 2020 to cope with the pandemic, soaring food and fuel bills caused by the war in Ukraine, the fastest inflation in 4 decades, and higher interest rates. All of this translates to less health care, less education, no social safety nets. The Washington Post reports the United Nations Development Program is now calling for world leaders to agree to a formal pause in debt payments when they gather at the G20 meeting in New Delhi in September. In Washington, I'm Amy Morris, Bloomberg Radio.
President Biden's campaign says it raked it in the second quarter. More than $72 million raised between the campaign and the Democratic National Committee in the second quarter. The fundraising reporting deadline is tomorrow. That $72 million figure is more than the rest of the Republicans combined, but the New York Times reports it is well short of the $105 million then President Trump raised at a similar quarter 4 years ago. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Jess and Simone.
Thank you, Nathan. We appreciate it. Jess Mitten and Simone Foxman here in the Bloomberg Interactive Brokers Studio. And Simone, you just sent over this story about this aspartame controversy sparking an FDA, obviously how it's rejecting this WHO report. Tell me more about what you were reading when it comes to that.
Okay, so there's been this long debate about whether or not aspartame is potentially carcinogenic.
The sweetener that's been added to so many, especially when I think of soft drinks.
Right, and it's been pulled out, mind you, of a lot of soft drinks over time, but we were watching this when we heard from the CFO of Pepsi yesterday after they reported earnings. He was on BNN and Bloomberg TV with us, and he really downplayed the effect of this report. So the report came out and was labeled, aspartame was labeled today as a possible cause of cancer. Now, there are 4 different ways of rankings, classifications by the WHO of potentially causing cancer. This is the second lowest, and the good news for those who love artificially sweetened drinks and other products is they don't recommend changing your intake if your intake is relatively normal.
Are you a big soft drink?
Oh, I drink so much Coke Zero.
I mean, yeah, the sugar.
Or Pepsi,
I'm a
whatever.
very bubbly person, so I try to pare it back when I can. But we'll have more coming up with Bloomberg Markets. Bloomberg Markets starts right now. Good morning.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Jess Mitten and Simone Foxman here in the Bloomberg Interactive Brokers Studio, filling in for Paul Sweeney, who I hear is probably still on the shore in New Jersey, enjoys in that beach house he has for the Sweeney compound. In the second hour here for Bloomberg Markets, we're going to be talking about commodities with Dr. Luisa Moreno, who's president of Defense Metals. She's going to discuss us the significance of China banning rare earth exports. We're also going to be talking about when it comes to the municipal bond market coming up too with Bloomberg's Joe Mizek. And so before we get into that, we're going to have another Bloomberg Business Flash here with Denise Pellegrini of Bloomberg News.
Yeah, Jess and Simone, I mean, for all he talks about that beach house, have you ever gotten an invitation there?
I haven't. I'm very disappointed about that.
He claims he has a beach house, right?
Allegedly.
It's a tent. I mean, I don't know what's
We'll
going on, but if he's listening, we're waiting. He can prove it to us. It's 11:01 on Wall Street now. Paul Sweeney. And we check the markets all day long for you here on Bloomberg. We do have a rally going. We're seeing stocks kind of pull back from what we had earlier, but we still have a lot of bullish things to talk about. First up, that Michigan preliminary July consumer sentiment, that came in at 72.6. The estimate was for 65.5. That's for July, and that was the highest since September of 2021. So consumers apparently strong. Amazon had quite a prime day. I'll tell you a little bit more about that in a minute. Bunch of bank earnings beat, including some big ones. That's contributing to the positive tone. And Anastasia Amoroso, she is chief investment strategist over at iCapital. She's really sticking to her bullish call. Check this out.
If we've got inflation that is easing, we've got the Fed that is pausing, and if you've got the consumer that is strong and is not going anywhere, then where's this equity market going to go? So for now, I think when I square the valuations, which are supported around these levels, and when I square that with 2024 earnings, which, by the way, have been de-risked a lot, that gives you close to 4,800 on the S&P.
Yeah, and Amoroso with us there on the Bloomberg Surveillance podcast. The Dow right now up 77 points, about 0.2%. The S&P 500 up just about 6. That's about 0.1%. The Nasdaq up 42, about 0.3%. Let's talk about the banks for a minute. J.P. Morgan Chase shares, they're higher after those quarterly results beat estimates up about 0.5% or so, hovering now for part of the morning. Citigroup, though, it started out higher. It's turned lower. We've seen as low as 2%. We're tracking that closely. Credit card business there doing well. Borrowers struggling, though, so that's something to watch for. Wells Fargo, it is up a little bit more than 0.5%. The yield on the 10-year right now, 3.78%, let's call it. NYMEX crude, it is lower, down 1.5%, 75.35 a barrel. And spot gold, it's just turned higher now, up 0.7%. We were lower by about 4%, so that's quite a move. 19.61 the ounce right now. And guys, I don't know if any of you are cat people, but according to the consumer data company Numerator, the #1 purchase during Amazon's Prime Day sales this week, Temptations brand cat treats.
Really?
This is according to a University of Buffalo marketing professor telling MarketWatch it all reflects the rise of pet ownership in the pandemic. It may also reflect the higher cost of pet food, of course. Amazon shoppers may have been on the hunt for deals to try to get their paws on this stuff because the price of a 12-pound bag of cat food has doubled in the past 3 years. If you see a lot of skinny cats walking around now, that's why. And that's your Bloomberg Business Flash.
I love the puns there, Denise. Thanks so much for that. I'm more of a dog person. I don't know about you, Simone. But...
I have one dog and 2 cats.
Oh, so you're both.
I am both. And my cats are not very skinny. So they're not terrible.
Bloomberg Markets is now on YouTube. Watch us every weekday starting at 10 a.m. on your TV, computer, or smartphone. Just visit youtube.com and search Bloomberg Global News. Taking a look at these markets, Simone, looking at financials, some of them coming off the gains, obviously looking at Citigroup, ticker symbol C, down about 2%, but you still have J.P. Morgan higher after those earnings. Also, if you want to take a look over at the S&P S&P 500. It's actually been up on course for 7 of the past 9 weeks, up close to about 3% this week. Looking at the NASDAQ 100 over the past 5 trading days, up about 4%. So if it can hold on to those gains, obviously it looks like it will since it's up so much this week, Simone. 9 of the past 12 weeks, that would put the NASDAQ 100 up that much, especially after the best first half to a year ever for that particular underlying gauge.
Yeah, and I mean, we're at the highest level in the S&P since April 2022. Right. I think if you go back to where the conversations we were having,
what a time that was,
back in March or even April, we would not necessarily be predicting the kind of move we have seen. Just an optimism coming through as well on the UMich Consumer Confidence Index. Consumers maybe much more confident than I think than the street.
And the S&P 500 is still trading above 4,500. And who better to come talk to us about the latest in the equity market than one of our star reporters on the team, Alex Simonova, who's going to take a look and walk us through some of the company moves and also covers strategy for us and covers all things what's going on with those Wall Street strategists. What are you taking a look at today, Alex?
Well, Jess, first of all, you're too kind to me. Thank you so much for that introduction. It's so great to be on with you guys. I do have to weigh in on the artificial sweetener conversation. I'm here powered by a Diet Coke. Can't get through earnings without it. And of course, speaking of earnings, all eyes are on bank stocks this morning as Wall Street's biggest institutions kicked off the earnings season with pretty reassuring start. If it's any sign for what's to come, the KBW Bank Index is actually on track for its best week since March. Thanks to those solid results today, JP Morgan and Chase & Co. was, of course, the curtain raiser after it reported, shares are up after a reported revenue soared to a record in the second quarter, lifted, of course, by the Federal Reserve's interest rate hikes and its acquisition of First Republic. Investors also paid close attention to what CEO Jamie Dimon had to say on the U.S. economy. He says that it remains resilient, consumer balance sheets remain healthy, and consumers are still spending money. Of course, he did flag some risks ahead, but those are important comments from the leader of the largest consumer bank in the U.S. at a time when many are still kind of waiting for this recession that everyone has been warning about. We're also looking at Citigroup. It posted net income and revenue that mostly met analyst expectations, though paring a gain from earlier today. It also reaffirmed guidance for the full year. Like JP Morgan, Citi also benefited from higher interest rates, helping partially offset a surge in write-offs tied to consumer loans. A similar story also with Wells Fargo. Shares are up after the company reported earning more net interest income than analysts expected in the second quarter while lifting its guidance for the full year. And then looking away from financials, we also have to talk about the mega caps. Names like NVIDIA and Microsoft are up today, helping lift the broader market and helping place U.S. stocks on pace for a sizable weekly gain.
You know, I'm looking at just what's happening in the shares of Citigroup. We're now down about 2.5% on the day, pairing our year-to-date returns to, well, less than 3%. And you know, I know we were speaking earlier with our Bloomberg intelligence analyst about this. It just seems, you know, is this because Alex, because the other earnings were so strong, or is it just because we're seeing weakness manifest in the day as people think everyone was overly exuberant about the banks going into today's earnings?
Exactly. So the initial reaction was quite positive because the bar was set so low, but as investors kind of look more deeply into the results and compare them, you know, to what we saw in 2021 and seeing that slowdown in deal making, they're kind of reevaluating, you know, and that's reflected in names like Citigroup. But again, banks did still report results that were much better than expected and are, you know, setting the tone for what's going to be an earnings season that perhaps won't be as bad as many expect.
And Alex, you do all things when it comes to strategy, and you had a really good story recently about how sort of this crystal ball for Wall Street strategists had shattered when you look at just where the average analyst estimate is for the S&P 500 year-end target, right below 4,100. So S&P 500 up above 4,500 right now. What is your sort of view whenever you're covering these strategy notes?
Yeah, it continues to be really interesting to see all these Wall Street sell-side strategists really caught flat-footed by this year's rally. Some of them have already changed their tunes and revised their outlooks, upwardly revised their year-end forecast for the S&P 500, but some continue to dig in their heels. Goldman Sachs wrote in a note today that potentially sticky inflation could spur some hawkish central bank surprises. That, combined with muted earnings growth, could limit limit the potential for further gains. They said that they see stocks in what they called a fat and flat range. Over at Bank of America, Michael Hartnett issued kind of a similar warning, saying that stubborn inflation and further policy tightening could grip markets in the second half of the year. Also interesting at Bank of America, there's a disconnect between some of the strategists' views. You know, we have Savita Subramanian,
right,
who did change her position. She said that she's the most bullish on stocks that she's been in a decade. She actually sees them, you know, having more room to run. I know that you had asked her in a recent interview about that, and she said that what she's looking at is that clients are saying they have a lot of cash on the sidelines that they're waiting to deploy if this rally continues, that, you know, recession expectations are coming down. She sees AI potentially fueling the rally further. And, you know, the S&P 500 has already blown through its average year-end price target, which stands at about 4,100 right now. We're at 4,500. You know, there was an interesting quote that Brian Belsky over at BMO said. He said that bears make you smart, but bulls make you money. And that certainly seems to be the case this year. You know, many people have missed out on the gains that we saw from this mega cap rally.
Right. Alex Simonova, one of our star equity reporters at Bloomberg News. Thank you so much for joining us. And Focus on Munis is brought to you by Build America Mutual, the new deal created by American Infrastructure that unleashed new opportunity. Today, we're doing it again with the massive investment in modernizing our infrastructure, and municipal bonds backed by Build America Mutual help make it happen. Invest in the future of America with BAM insured bonds. And who better to come up with us next than Bloomberg's own Joe Misick, editor of Bloomberg Brief Municipal Bonds. Now, Joe, it's always great having you in studio, especially on a Friday.
Jess.
We always get excited to do the BAM on Fridays whenever you're here.
BAM!
So walk us through what's happened. What's the latest when it comes to munis?
Oh, wow. This was a very big week. We had a lot of stuff going on. You had Detroit come to market. You know, it's been back to market since the bankruptcy, but, you know, it came to market this week. And you also had Bank of America re-enter the Texas muni bond market. So that was a big deal. They won a Frisco, Texas deal, and their bid beat out the cover bid by 5 basis points, which in the muni market is enormous. And you also had this weird situation in Illinois where you had the state all of a sudden making a kind of surprise settlement offer, taking the relator of this VRDO lawsuit that's been dragging on for almost a decade by surprise. So we have just a ton of material going on this week in the muni market.
Can we start off with this Bank of America winning this offering by Frisco in Texas? One of the things that Matt Winkler, our editor-in-chief emeritus in particular, has been pointing out is that the likes of Texas, which has limited its business with banks doing investing on an ESG basis, has actually suffered for that in the bond market. Does this sort of development change the game?
Well,
long pause there.
You know, we haven't seen, actual analysis yet, but I have to think a 5 basis point difference shows other issuers in the state of Texas what they've been missing by keeping Bank of America in the penalty box, if you will. Now, Bank of America comes in and says, hey, by the way, we're coming back in your market because we think we're in compliance with all of your rules and regulations. And I have to think that the state itself, knew perfectly well, hey, Bank of America is coming in. They didn't say, no, go away. So we shall see. But I think, yes, this 5 basis points, that's kind of a game changer. And Bank of America is sending a message.
I want to get your thoughts because I was taking a close look at the flows data this week from Lipper and looking at, for the second consecutive week, municipal bond ETFs actually witnessed outflows, redeeming about $132 million this week. If you look over at VanEck Long Muni ETF, that actually witnessed the largest draw of net new money of the municipal bond ETFs. Why do you think we're seeing this dynamic right now?
Well, the ETF market is very attractive to a number of people, especially as credit sites pointed out a couple of weeks ago. It's especially attractive to younger investors rather than mutual funds. So
That's interesting.
That's why you'll see muni ETFs. And this was Pat Luby at Credit Sites. He actually thought that we would see some smart growth in the muni ETF market. Of course, on the other hand, the ETF market is a very small piece of the pie right now.
It is, right.
Are they going to grow? We'll see. They have this kind of, and they have their own little weirdnesses too. They have these, I don't want to call them, they're almost like brokers, right? They have the intermediaries in the ETF market. So, it's one of those, the ETF sector has been, I would say, a pleasant surprise to the muni market over the past year, where we have seen all kinds of outflows from the mutual funds.
Can we talk, another story I know you're covering closely is Detroit issuing $100 million of junk-rated debt. Give me a sense of the impact for this and turnaround for Detroit continuing, or a little bit more complicated signal?
Well, I would say, this is, I think, the third sale they've made since the bankruptcy back in 2014. The Detroit bankruptcy was so jarring to the muni market because, here you had Kevin Orr, who's running the city, saying, GO bondholders, you're going to take a haircut, which was to the muni market astounding. What?
Astounding.
GO bondholders? How is that possible? So now here's Detroit. It's third sale in, still junk rated. Do you trust them? I don't know. That's the big question you have to answer. Is Detroit back? Sort of. I mean, I like these bonds are being used to remove blighted housing from the city, which the city has been working on for the last decade or so. So, things looking up. Yeah,
Ish.
A little ish.
You trust them? I don't know. I guess people did. They did well this week. I mean, we had people say, wow, we haven't had muni high yield in the market, and people jumped on it because, after all, it's city of Detroit.
Joe, we'll have to leave it there
on
that bout of optimism.
That's Simone, come
Joe's
on.
with our Munis in Focus, the editor of Bloomberg Brief, Municipal Bonds. Now let's get some company news with Bloomberg's Steve Rappaport.
Morgan City and Wells Fargo all posting better than expected revenue for the second quarter. But as Bloomberg's Shonali Basak reports, there are signs of bad news on the horizon.
That is worries still about commercial real estate. Goldman's earnings next week, according to Semaphore, is about to have $2 billion worth of write-downs tied to both green sky loans as well as commercial real estate. So we'll see some pictures there about what that could look like. Wells Fargo also raising its expectations for expenses, partially tied to severance, and Citigroup's expenses also coming in above line for expectations here.
Thanks, Sonali. Norovirus cases on cruise ships are surging in the post-pandemic demand for travel. Bloomberg's Gina Cervetti has more.
Steve, there have been 13 norovirus outbreaks on cruise ships this year, the most the U.S. has seen in more than a decade, and more than there were for all of 2022. The latest outbreak occurred last month on a Viking Cruises ship from Iceland that docked in New York, with 110 passengers and 8 crew members getting sick. Norovirus is described as a stomach bug with symptoms including nausea and diarrhea. Like COVID-19, transmission typically occurs in crowded spaces where particles float in the air. But unlike COVID, norovirus cases are usually not fatal. Steve?
Thanks, Gina. The PGA Tour and Saudi-backed Live Golf have dropped a provision in their framework agreement that forbids poaching of golfers. That tweak comes as regulators and lawmakers are stepping up antitrust scrutiny over the merger. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up right after this.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:21 on Wall Street. We check the markets for you all day long here at Bloomberg. We're looking at consumer confidence, that University of Michigan consumer confidence for July. It did come in way stronger than expected. That's the preliminary number, so we'll see what happens, but that was certainly bullish for investors. And stocks overall, they are higher. Let's check now the Dow, the S&P, and the NASDAQ. They are all trading higher. Bank stocks also in focus. Wells Fargo, Citigroup, JP Morgan Chase, all reporting quarterly results this morning. They did all beat on some levels, but there are concerns. We've seen JP Morgan shares now turn negative. Citigroup, it's been negative for at least an hour now. Wells Fargo shares, they're still holding on, so we will be watching those bank stocks all day long for you here on Bloomberg Radio. And that is a Bloomberg Business Flash.
Thank you, Denise. We appreciate it. Jess Minton here with Simone Foxman in the Bloomberg Interactive Broker Studio. And I want to get straight to our next guest. Ethan DeWitt, CIO at Moneta, joins us to talk about this week's inflation data when we're looking at consumer CPI, as well as producer prices, along with the latest on the outlook when it comes to all things with markets and investing. Thank you so much for joining us. I wanted to start off and just kind of get your view and your take of the latest market action today in the equity market on the back of these bank results and the earnings from JP Morgan and others when it comes to Citi, that's dragging things a little bit lower in the financial sector.
Well, the financial sector has really probably not had the attention it deserves, given what a hotbed of chaos it was in the first quarter and towards the end of that. It did seem that that regional bank crisis got swept under the carpet a little, and it wasn't fully understood how that was going to ripple through the economy. So I think it's appropriate. We saw in the last few weeks the significant write-downs by the likes of Bank of America, and just this bond market has taken its toll on bank stocks. And what we can see from the regional banking sector is just how exposed they are to quite a fickle consumer and depositor, essentially, when trouble starts to brew. So we've always suggested that it would take some time to really fully understand what kind of problems the banking sector was facing. And when we see these kind of very mixed picture coming out of banks, certainly we're seeing a bit of a pickup in some trading, and asset pools are growing thanks to equity markets. It's only natural that investors will start to try to dissect that, pick and choose where the opportunities are. So I'd say we're not seeing the end of this banking crisis yet. So that's why it doesn't surprise me that there's a little bit of I suppose, just a little bit of just a delay in terms of processing this, and less exuberance than we might expect.
Ethan, so you're saying not the end of the banking crisis yet. How do you expect to see this play out when we get some of the regional banks, some of the other banks come report their results next week?
Well, certainly there is a lagging effect always in these bank results. We only know at the end of the quarter how deposits had moved. And we only know then, of course, what write-downs, if any, are being taken on a fixed income book. So with the Feds looking set to continue its increase in rates, that's going to still put pressure on some of these securities holdings. This was perhaps an unintended consequence of the steepest rate rise trajectory we've seen in recent history, but it was not unanticipated. It should have been anticipated that this would take its toll somewhere after the bear market we had in bonds last year. So what I expect is, and we can see that regional banks have seen no pickup. We've seen no bottom fishing almost whatsoever within those banks since the trouble started brewing back in February, March. So I'd say that indicates that investors are very happy to sit on the sidelines when it comes to financials today, and will remain on those sidelines. Is more than enough to attract them elsewhere in the equity sectors that are looking more promising and have more upside today. So I expect a very low level of enthusiasm around financials. And as far as what the regional banks are likely to come out with, I think it's going to be challenging. I think they may spin it in different ways, but it will be challenging.
So then how are you advising clients to position at this point? Where do you think they should put their money?
We have always had it's almost like our message doesn't change. We talk about core exposures. We like to have exposures across growth and value segments. We like exposures that are international in flavor, that include emerging markets, developed markets, ex-US, and of course, a very strong core allocation to the US. None of that changes. So we're still quite keen on that. And I'd say what we're advising is to look at the underloved sectors. Everyone's talking about the top 7 stocks today. Those stocks that are really showing and lifting the market almost single-handedly, those 7. Everything else is lagging and is very lackluster year to date. Since the numbers are better than expected, the consumer, the economy, everything's stronger than expected, we think that that goodwill should trickle down across sectors. So we'd expect that other sectors will start to participate more and more now. And therefore, for our clients, we're saying, stay invested in core, stay balanced, don't neglect value, look at the less perhaps exciting sectors today, less momentum, but around healthcare, industrials, consumer staples. That's where we think the next leg of this rally will happen.
Now, even you mentioned healthcare there. In addition to the fact that you are quite healthy, have run a fun fact here, our producer pointing out, 51 marathons.
Amazing. Wow.
So hopefully you do not have to rest on the services of the likes of United Health. The health insurer reporting today had talked up these rising costs in its the potential for rising costs, people going back and getting all the elective procedures that they had put off during the pandemic. What's your thesis there if healthcare is something that's among your winners sector-wise?
It's interesting. Healthcare is undergoing transformation just like many other industries. And certainly there may be this imbalance post-COVID of, as you mentioned, elective surgeries. I thankfully haven't needed anything to be replaced yet.
Thank goodness.
But I could stand the line if I continue beating the sidewalk. So that one is one thing that is perhaps an anomaly that will work its way through. But with the advent of digital health, with more telemedicine, and particularly AI, and nobody's really paying a huge amount of attention to just how much AI is going to transform the healthcare industry, transform the insurance industry. I've spoken about financials before, we focused on banks. But when you look at more broad financials, insurers are overall winners here in the current transition to use of AI and bigger data, because they can calculate with a much more precision the risk involved in their insureds. And they can take this data and use it to do better underwriting. They do also have a certain amount of pricing power. As we all know, we're not exactly, when it comes to negotiating our car insurance, our house insurance, we're not always in a position of strength. It's usually the insurers that have that pricing power. So they're seeing really strong margins being protected. Digital health, of course, will ultimately drive costs down if we can use our telemedicine, if we can have more control in the holder, in the patient of their healthcare, less reliance on expensive services. That trajectory is deflationary, we believe, for healthcare. However, yes, in the short term, there probably will be the spike, which is the post-COVID reckoning that we're seeing in other sectors too.
You brought up industrials, which I think is interesting because when you look at that particular group in the S&P 500, it's actually trading at records. And that's a particular group that, as you know, cyclically oriented, very tied to the health of the economy. What do you think this tells us about the trajectory of the equity markets, as well as how that ties in to economic growth?
Well, this is the economy that is proving to be surprisingly resilient. And I think it's really bucking many commentators' expectations as to just when this recession, if it ever comes, will come. And in a way, it's almost an unbreakable economy. I wrote a piece today about how it's almost anti-fragile, to borrow Nassim Taleb's phrase, in the sense that no matter what monetary policy or fiscal policy throws at it, the economy continues to be resilient. And I'd say that I've also been hearing that there is an unprecedented amount of capital on the sidelines, on company balance sheets, to be spent on CapEx waves. In some ways, it's compared to post-war spending. Not only do we have this pent-up demand for spending because there hasn't been much during COVID, but also things like the Inflation Reduction Act and the stimulus packages, which are providing incentives to invest in those technologies that are tied to the transition economy. All of this bodes very well for industrials. AI is going to require tremendous investment in facilities, in chemicals, in stuff, and batteries, et cetera. And that's all going to bode well. So this is the trickle-down effect. The first layer has been in tech stocks, where you could naturally expect that we'd have more in terms of the AI hype cycle. But now it's going to actually be implemented, and the investments are going to happen. And just like cybersecurity is a non-negotiable part of a corporate spending trajectory right now, we're going to see investments in technology non-negotiable, and that all bodes well for the component makers.
Yeah, so looking beyond the semiconductors, the hot names, the NVIDIAs, even we only have about 30 seconds here, but talk to me. We've seen some contradictory indicators, one of them being housing, about where the future of the economy goes. Your quick thoughts, because we get some big numbers next week. What do you expect to see?
Yeah, housing is, as you said, a mixed indicator. We have some of the highest mortgage rates we've seen in decades, back to their peaks, but that doesn't seem to be biting the consumer. Many locked in their rates at lower levels. And we can also see this quite a mixed picture. We've seen the average price falling, but yet demand and housing starts rising. And that, of course, indicates how checkered this market is. In that some of the hot segments, say that the Nashvilles, the Florida, that will actually be quite strong. I'm here in the Midwest in Chicago. We might see some of our pricing a little softer. So it's going to be mixed. Definitely with the post-COVID economy, we're still seeing a strong demand for people to live in those houses with those home offices. And I think within the real estate segment, office is the sick sector right now. Residential is quite robust.
Ethan, thank you for giving us such a broad outlook on so many sectors, where we head with the U.S. economy. We really appreciate it. That's Ethan Devitt, CIO at Moneta, with AUM $27 billion, managing the money, looking at the markets, and some interesting thoughts there on housing, particularly as we head into a big week of data. This is Bloomberg. Now let's get to Washington, D.C. for world and national news with Bloomberg's Nathan Hager.
Okay, Simone, thank you. The House has narrowly passed a defense policy bill that comes with a slew of social policy measures. The vote was 219 to 210 with nearly unanimous GOP support. Democrats came out against this bill after conservatives tacked on amendments related to abortion, LGBTQ rights, and racial diversity. This is Texas Republican Ronnie Jackson.
Taxpayer money is intended to provide for our national defense and our national security. It is not to promote and support the Biden administration's radical, immoral, pro-abortion agenda.
Ahead of the vote, White House spokesman John Kirby told CNN President Biden would not support a bill that negatively affects military readiness. The Senate will take up its own version of the must-pass defense policy bill next week. It could be the break in a string of murders that has gripped New York's Long Island for more than a decade. Police arrested a suspect last night in the Gilgo Beach killings. The New York Post has identified the suspect as prominent architect Rex Heuermann. This man tells ABC News he has lived in the area for more than 30 years.
The guy pretty much keeps to himself. We just say hello to each other, and that's about it. You know, how you doing, blah, blah, blah.
Now, the suspect is due in court later today, and the Suffolk County District Attorney's Office has set a news conference for 4 p.m. Wall Street time. The Supreme Court may have thrown out President Biden's $400 billion student loan forgiveness. Now the administration's forgiving about 10% of that. The Education Department announced a $39 billion reprieve for about 804,000 borrowers who've made the equivalent of 20 to 25 years of payments. Novak Djokovic is closing in on a record-tying 8th title at Wimbledon. He repeatedly served his way out of potential trouble to beat Jannik Sinner in the semifinals today. The finals coming up this weekend at the All England Club. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:41 on Wall Street. We check the markets all day long for you here at Bloomberg. Stocks are higher. We do have this University of Michigan consumer sentiment number out. This is the July preliminary number coming in 72.6. That is way, way, way hotter than the 65.5 expected, and also the highest since September 2021. And it is notable that stocks are still higher in spite of that hot number. Investors appear not to be too worried about more interest rate hikes from the Fed, at least at the minute. And that's possibly because we had a bunch of bank earnings beat, including some big ones. That's contributing to the overall positive tone, although some of those banks are negative right now in terms of the stocks. Ken Leon, Director of Equity Search, CFRA, says gains in asset and wealth management at some of the banks are astonishing. Rivals may struggle to keep up.
These are phenomenal numbers, and it speaks to making the right strategic decision to expand in asset and wealth management. That's what Goldman Sachs, unfortunately, will have to talk about next week, where they made the wrong turn and they're trying to play catch up in these amazing areas.
And Leon there on the Bloomberg Surveillance podcast. Let's check stocks right now. The Dow, it is up 130 points, about 0.4%. The S&P 500 up 10, about 0.2%. The NASDAQ up 55 points now. That's about 0.4%. JP Morgan Chase shares fluctuating between the positive and negative after reporting earnings. Citigroup down more than 2% for much of the hour. Credit card biz doing well, but borrowers struggling. Also, the cost of layoffs may be an issue, and client deposits are on the decline. Wells Fargo also reporting it beat shares up about 0.5%. The yield on the 10-year right now, 3.79, almost 3.8% really when you think about it. NYMEX crude, it is now lower, down 1.3%, 75.61 a barrel. And spot gold, it's lower again, down about 2% at $19.58 an ounce. And guys, business and sports leagues are actually now scaling back all those drug tests, at least for cannabis, that you used to have to take. Yeah, one of the reasons, of course, is that, casual marijuana use more legal now across the country. And also they want to build a more diverse applicant pool. Now, I don't know if that just means they want more different kinds of people or if they want to include stoned people. But anyway, they're looking for more diversity. Recreational marijuana, of course, reached historic highs last year in terms of use. That was not a pun. That's according to drug tester Quest Diagnostics, a direct quote. And Bloomberg Law is reporting that Amazon, AutoNation, among the large employers now dropping marijuana from employee drug testing programs. Caesars Entertainment, that's the largest casino in Vegas, they're also dropping. And now the National Basketball Association is reaching a deal with Players Union to remove marijuana from its prohibited substance list. And Major League Baseball and the National Hockey League are also relaxing their marijuana testing. So if you want to get stoned and be a pro sports player, guys, you can still do it.
There you go.
And that's your Bloomberg Business Flash.
Thank you, Denise, as always. We appreciate it. Jess Mitten and Simone Foxman here in the Bloomberg Interactive Brokers Studio. And we want to switch things up. So we've been talking so much about the stock market. Now maybe we do a little bit of a commodities chat here. And our next guest, Dr. Luisa Moreno, who's the president of Defense Metals, who's discussing the significance of China banning rare earth exports and how it affects the U.S. and production around the world, joining us on Zoom. And please, can you set the scene for us and explain why is China banning rare earth metal exports at this point?
Thank you. Thank you very much for having me. So China has essentially said they are planning to impose export restrictions on some rare metals, specifically gallium and germanium, which are critical for semiconductor applications to make chips effectively. So they have not yet imposed export restrictions on other rare metals, such as rare earth elements, which we at Defense Metals are planning to produce. Those are critical for applications, for green applications, like electric vehicles and wind turbines. But it seems that the fact that China is imposing some restrictions now on semiconductors, it is highly likely that they would have the power, certainly, and potentially they might also impose restrictions on rare earth.
You know, what's interesting here is we've seen in the last couple of days, according to a Shanghai metals market report, they're a researcher in the space, that there was sort of a rush for overseas buyers to buy up as much Chinese gallium as they could, and then that sort of dissipated. What's your take? What have you heard from folks that are looking to buy these sorts of metals?
So usually these minor metals, they are applied in small quantities. You know, the volumes of sales are also significantly lower compared, for instance, with iron ore, which is in the billions of tons. And so they tend to buy them and keep them in advance for 3 to 6 months or more sometimes. And so probably that's what we saw. So they went in, with the news, some traders and some end users might have stockpiled a little bit more to extend whatever stockpiles they already have, which led to an increase in the price of gallium. And now they might just perhaps sit back and see how this, I guess right now, a threat from China will play out, and how U.S. and the rest of the world will respond to that.
And when you're talking about these potential chip curbs, my ears perked up because as an equities reporter here at Bloomberg, obviously if you look at the NASDAQ 100, up more than 40%, a lot of this was juiced by AI in recent months. Not just that, but also some margin when it comes to cost-cutting pressures that have helped some of those companies. But when you think about AI in the companies you brought up, EV makers, and then these semiconductor-type companies that obviously have a broad exposure overseas, what do you think this means for them after this massive rally that we've seen, especially in the chip space?
Well, it seems that there has been, some issues with the supply of chips in the last couple of years, especially since COVID. So this export ban, considering that China produces most of the gallium in the world, I believe more than 90%, if they will impose export restrictions, that means that many of these companies are not going to have access to the basic material that they need to make those chips. So that will lead to potentially an increase in prices for these chips and supply issues. And so it just will mean that the same problems we saw before. Automakers are not going to be able to make certain models, and folks in the telecommunications, smartphone producers and others might have a hard time producing their products.
We have some reporting out suggesting that these export controls could potentially backfire. Your take on that?
Backfire for China?
For China, yes. That I suppose other countries will ramp up their production to the extent that they can, that it may hurt trade overall. What's your take?
I think China is more concerned about having access to advanced chips right now and the equipment that they need to make them as well, than the supply of gallium. So I think they understand that it will take time for the rest of the world to be able to produce the gallium and the gallium products like gallium arsenide that we need to make these advanced chips. So it will take time for the rest of the world to be able to ramp up production of gallium and then build the supply chain to be able to produce these finished products that are critical for semiconductors. The situation for China is already critical for them as far as having access to this equipment to make chips, advanced chips, and the chips as well that they are produced in the Netherlands and in the United States.
Lisa, thanks so much for breaking this down for us. That's Dr. Lisa Moreno, president of Defense Metals Corp., discussing the significance of some of these China moves. And interestingly, the OECD has warned that these export restrictions may actually threaten the green transition. Very interesting stuff as these China tensions with the U.S. seem to ramp up. This is Bloomberg. Now let's get some company news with Bloomberg's Steve Rappaport. Steve.
Hi there. Good news for the big banks. They continue to benefit from the Fed's rate hikes. J.P. Morgan Chase's revenue soared to a record in the second quarter. The firm's more than $41 billion in total revenue, beating analyst expectations. Wells Fargo earned more net interest income than analysts expected in the second quarter. And Citigroup reaped gains as customers borrowed more, even as a growing number of consumers struggled to make credit card payments. Shares of J.P. Morgan currently up less than 0.1%. Wells Fargo up less than 1%, while Citigroup is down more than 2.9%. Cantor Fitzgerald will pay $1.4 million to settle allegations from the SEC that it failed for years to notify the regulators about clients considered to be large traders. The firm did not admit or deny the allegations as part of the settlement. And Tucker Carlson is making a play to get back on the air on his terms. Bloomberg's Kimberly Adams reports.
Steve, former Fox News host Tucker Carlson, and former White House advisor Neil Patel are seeking to raise millions to start a new media company that would potentially use Twitter as its backbone. According to Dow Jones, the new company would be anchored by longer versions of the free videos that Carlson has been posting regularly on Twitter since shortly after his departure from Fox News, but would ultimately be driven by subscriptions. Users of Twitter and other platforms would still be able to watch free, shorter versions of his shows, interviews, and documentaries, but would still need to subscribe to watch them in their entirety. Steve?
Thanks, Kimberly. Carlson remains under contract with Fox News, but is trying to get out of it, claiming the network breached the terms. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Jess Mitten and Simone Foxman here in the Bloomberg Interactive Brokers Studio. And Simone, I know we've been taking a look at the markets here. The S&P 500 up about 3% this week, on track for gains in 7 of the past 9 weeks.
Yeah, it's pretty amazing to see how far we've come. Highest S&P since early April 2022, so well over a year there, and just a bunch of optimistic indicators today. Optimism, the name of the game.
Now let's head down to Washington, D.C. for World and National News with Bloomberg's own Nathan Hager.
Okay, Jess, thank you. A defense policy bill has passed the House that includes a string of policy orders for the Pentagon to stop paying for things like abortion travel, transgender care, or racial diversity efforts. The measure passed almost entirely along party lines. Texas Republican Chip Roy spoke out in support.
I rise today to ensure that the Department of Defense is focused on its core mission rather than pursuing the political agenda of climate change to the detriment of the national security of the United States.
Well, House Democrats lined up in opposition to the bill. The Senate's going to consider its version, which does not include those social policy amendments, next week. More than a decade after a string of killings that gripped the New York City area, a suspect is in custody in the Gilgo Beach murders. The New York Post identifies him as Rex Heuermann, the founder of a Manhattan architecture firm. This man lives in the Massapequa neighborhood where that arrest was made last night.
I do believe we did trick-or-treat at that house through the years, you know. So it's very scary to wake up to this.
The suspect is expected in court today in connection with 4 women whose remains were found near the beach in 2010. The Suffolk County DA's office is planning a news conference for 4 p.m. Wall Street time. Hollywood is on strike. Union actors have joined the writers on the picket lines in New York and Los Angeles for the first industry-wide work stoppage since 1960. Bloomberg's Ed Ludlow reports, though, the issues are very 21st century.
They're really worried about the underlying technology of a generative AI tool that turns text into video image, and the future of being able to replicate someone's own write, their own image, artificially.
Bloomberg's Ed Ludlow reporting there from the Allen & Company conference in Sun Valley, Idaho, where a lot of studio executives are on the guest list. President Biden has kicked off his re-election campaign with a $72 million haul. The president's campaign announced its second quarter fundraising a day before the reporting deadline. Could ease some big donors' fears that the president's race is off to a slow start. That $72 million take includes funds for the campaign and the Democratic National Committee. It is more than twice as much as GOP frontrunner Donald Trump reported in the second quarter, but it is less than the $105 million then President Trump raised during that same quarter for his re-election campaign 4 years ago. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Jess and Simone.
Thanks, Nathan. Jess, you were pointing out a really interesting column from your team by Esha Day.
Yes.
Ned Davis saying that the need to hide in large caps is now over. Is this the time for small caps to win, I wonder?
Especially because, so this is a taking stock column that we do every day. Esha is one of our star reporters on the team. So it's taking a look at how, particularly the Russell 2000, when you're measuring what the performance for small caps are doing, that had been underperforming the S&P 500. Typically, small caps are the ones to lead the way. They tend to bottom before large caps. Coming out of a bear market, we saw coming into this year some strength there, but then in recent months they pulled back. But if you look at the end of May up to now, the Russell 2000 gaining more than 10%, outperforming the S&P 500 in that span, and also trading above its 200-day moving average. So now you're starting to see these more cyclical corners of the market, and especially when you're thinking about domestically, right? Because small companies really on the strength of the economy doing well, and not just small caps, but also what we're seeing. We talked about industrials earlier as well, and also materials holding up well. So these are very, when you're thinking about the healthy economy and then more breadth in the market, it's a good sign to see this holding up.
Yeah, and among those Russell 2000 groups, tech, industrials, consumer discretionary, all leading the way, both up double digits for the year. Coming up, more markets starts right now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Jess Smitten and Simone Foxman here in the Bloomberg Interactive Brokers studio, filling in for the Paul Sweeney, who is taking this summer Friday off to enjoy some time, well-deserved, at the Sweeney compound on the shores of New Jersey. Up next in our final hour with Bloomberg Markets, we'll be discussing problems with pensions as well as C-suite conversations on AI, and of course, getting another check here on the markets as well. And before we get to all of that, let's get a Bloomberg Business News Flash with Charlie Pellet of Bloomberg News.
Thank you very much. And here's what's going on. We have got the Dow, the S&P, NASDAQ all advancing right now. S&P 500 index up 7 to 45.17. That is a gain of about 0.2%. The Dow up 128, up by about 0.4%. NASDAQ up 42. That is a gain of just about 0.3%. NASDAQ 100 index powering higher by 90 points, up by about 0.6%. The Russell 2000 in the red, down 1.1% right now. 10-year yield 3.80%. We've got the 2-year yielding 4.74%. Spot gold lower, little change, down by about 0.1%. Gold right now is at $19.58 the ounce, and West Texas Intermediate crude down 1.4%, $75.83 a barrel. Bottom line here: the Dow, the S&P, NASDAQ all advancing. Stocks heading to their best week since March. Traders sifting through solid results out of JP Morgan Chase, Wells Fargo, and Citigroup. Allison Williams is a senior bank analyst for Bloomberg Intelligence, and she was a guest this morning on Bloomberg Surveillance.
You know, the most interesting things that I'm seeing this quarter, and what might set apart these banks from some of the regionals, is the credit card business, and that is really helping the net interest income. You're seeing the guidance being raised across these banks. Citigroup has weaker fees, so they're guiding up on net interest income, but flattish revenue. But I'm not sure we're going to see that across all of the regionals that are reporting next week.
And you can hear more of the conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcast. JP Morgan Chase higher now by about 0.3%. Citigroup down 2.7%. Wells Fargo up by 1.5%. So again, recapping a Friday rally underway with the S&P higher now by about 0.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Smitten and Simone Foxman here in the Bloomberg Interactive Brokers studio. And Bloomberg Markets is now on YouTube. Watch us every weekday starting at 10 a.m. on your TV, computer, or smartphone. Just visit youtube.com and search Bloomberg Global News. So Simone, still looking at the S&P 500, just virtually mildly higher. But if you want to look on an industry group level, looking over at healthcare, up more than 1%. A lot of that driven by, not surprisingly, United Health, ticker symbol UNH, gaining about 7%. So the managed healthcare company actually reported adjusted earnings per share for the second quarter that did beat the average analyst estimate. But overall, you're looking at the S&P 500 on a weekly basis, up close to 3%. So that would put it on track for gains in 7 of the past 9 weeks.
That's right. And I think, you know, it's interesting. We talked about optimism being the name of the game today, but we've seen that come off just a little bit in the stock market. Bond markets, though, we are seeing yields move, you know, a bit higher as we get into that trading session.
Right, and who better to give us another update? How lucky are we? We get Bailey Lipschultz, one of our star reporters on our equities team, joining us for not once but a second time this morning. So in the 2 hours since we last saw you, what are you taking a look at now?
Yeah, no, Jess, I think it's still the same trends that are driving the market. Obviously, we are not as high as we were when we when we spoke at 10 o'clock. Obviously, we saw the S&P actually dip into the red territory this morning. But it is, as you mentioned, very much driven by United Health and managed care companies. As you mentioned, United Health beating expectations. Just last month, though, remember, their CFO was talking down expectations, calling out rising medical costs, how that would impact the company. So you saw last month a risk investors taking some of those profits in the likes of United Health, Elevance Health, Cigna, and Centene. Well, those are 4 of the 5 best performers in the S&P 500 today. day. So
Right.
it does seem like this earnings report may be allaying some of those issues and concerns that health investors were looking at, again, on a day where you have crude trading lower as investors take profits. You see energy stocks down about 2%. It really is being led higher right now by healthcare and those big technology companies, biggest drivers in the S&P, Microsoft, United Health, NVIDIA, Amazon, and Tesla. So really no shocker there, just given where this market has been.
That's absolutely right. And I think the healthcare space is interesting, though, because these are sort of generational trends, right? First off, costs were higher because people post-COVID going back saying, I'll get that knee replacement surgery that I so desperately needed and didn't do for the last couple of years. Is the story on the margin side? Is it just better than a lot of analysts had feared?
It's better than feared. It's the same thing that we saw at the start for the most part with big banks. It was, if you talk down numbers and expectations, and then you over deliver, guess what? You beat earnings.
I feel like that's a trend.
Formula they always use, right? We saw this last earnings season, but this is what we typically see every earnings season.
Exactly. I was actually talking to a health specialist, though, who pointed out, interestingly, he was like, I would have expected MedTech to be trading higher off of these earnings because United Health basically said third quarter utilization is going to come in around the 1Q, 2Q range, which was hot and hotter than expected. But it does seem like that was very much baked in based on the reaction we saw, again, sharp last month when United Health CFO came out and was basically saying, things are bad. People are getting knee and hip surgeries and kind of everything that they had been putting off for quite some time, which obviously that cash goes into United Health's pocket. And that's why it's really been one of those tremendous stocks from a long decade perspective. Is one of the, if not the biggest health company. I don't know quite right now if it's bigger than Eli Lilly. It's something that we've been tracking, but those are 1 and 2 in the U.S.
Yeah, they definitely have been rivaling when you're looking at their market cap for both of them recently, especially. And another company I know you're taking a close look at, I mean, we've talked so much about banks this morning, obviously like the major lenders, but what about when you're talking about, say, other corners of that particular group, say State Street?
State Street earnings were fascinating because this is a company that helps institutional investors and manages assets. And when you saw the print, it read like they beat expectations, but then you kind of look into the analyst reaction.
Right.
This is a stock down 10%. And it's really analysts downplaying what drove the results, saying that the sources of the upside relative to consensus estimates were low in quality. Bloomberg Intelligence analysts basically saying that the adjusted expense growth still outstripped revenue in 2Q. So you're looking at a stock down the most since April, trading at the lowest level since early June, down 10%, one of the worst performers in the S&P 500, which kind of goes to show that as the financial market, or as financial companies continue to kind of digest where the Fed's at, where things are going with bonds and stocks, it's not a winner take all. It's not everyone kind of trading up and to the right like we had at least expected based on JP Morgan, Wells Fargo results really kicking things off today.
Right, looking at that ticker symbol STT, so you're talking about how it's down close to about 10%. So intraday on pace for its worst day since mid-April, but you look at a closing basis, it would be its worst day since March of 2020. So quite a move there when you're looking at State Street.
Yeah, and this is a company, again, when you look at kind of where it's been trading, the stock right now around $70 was trading back above 90 in early February. So when things had been shaking out with the financial or the banking crisis, you saw it go from about 95 to 75. So it's still kind of trending in that broader range. I don't want to call it a range. You're the one who knows technicals better than I do, Jess. But it's not a great looking chart just from an investor perspective.
Pretty.
Yeah.
What are your thoughts?
Yeah, what else are you watching, Bailey?
I know we talked about it earlier, but I think this Leslie story is just fascinating.
Yeah.
I mean, this is a company that came out with earnings slashing expectations, on pace for its record close, trading at a record low on an intraday basis, now around $6. When you look at Leslie's Pools, this is a company that primarily sells things like chemical cleaners and other kind of goods or assets that you use to keep and maintain your pool. It was trading north of 30 back in 2021, and I don't think from a use case standpoint you would have expected a bump up in pandemic or post-pandemic reopening trade. This wasn't a company that was caught up in that. This is just a stock that really has been trending markedly lower for the last 2.5 years. And when you completely whiff on earnings, that's going to weigh on some peers. And one of those peers to keep an eye on is Pool Corp. It's a company that is not as exposed to chemicals, so still trading sharply lower than it was earlier, or was yesterday, but still holding on much better relative to Leslie's, which has, again, been the opposite of what you would want to see, again, from a fundamental standpoint.
Yeah, and I mean, you always talk to us about SPACs, too. I know you were taking a close eye on an EV maker that's tied to the SPAC space. What are you seeing there?
Yeah, this was a fascinating company. So this is Black Spade, ticker BSAQ. They're bringing a Vietnamese EV maker called VinFast public. Gave them a valuation of about $27 billion, and they only raised $169 million. Well, 84% of the shareholders redeemed their shares for cashback, which is something that protects SPAC investors, but is really raising questions whether this deal will actually get done. And again, this was, by one metric, a record-breaking SPAC pack, which is kind of shocking given some of the deals that had rolled out over the last 2 years, and we've seen a lot of those stocks trade sharply lower. So this will be one to keep an eye on for investors, at least just wondering where we are at in the SPAC life cycle.
All right, Bailey Lipschultz, star reporter on our U.S. equities team, joining us for a second time this morning. Always a pleasure getting an update on the markets from you. And I want to turn things over to our next guest, who's one of our own Bloomberg Wall Street reporter, Sri Natarajan, who's joining us to give us a breakdown of these earnings. And so we've been talking about this all morning when it comes to JP Morgan, Wells Fargo, Citigroup kicking off second quarter earnings for this particular group, and then obviously offering this first glimpse to a period that included that tumultuous time among those regional lenders in the spring that was capped by the failure of First Republic. What's your takeaway here this morning?
Look, the big takeaway is the big banks are doing just fine. You expected, you wanted to hear what they had to say on net interest income, which is how much do they have to pay out on the deposits that customers have with them, how much do they make off the loans. You knew through the first half of the year, because of the rising rate environment we were in, that number was going to go up, but everyone was interested in what the outlook was going to be for the rest of the year, and they offered some really good guidance, both at JP Morgan and Wells Fargo initially, and later at Citigroup. They all boosted their NII guidance, which even if they're facing pressure to raise deposit rates for customers, they feel comfortable that they will still grow their income base. When you have that and you're throwing in good numbers, JP Morgan, for instance, with a record revenue quarter, if you're doing that right now, when you think about the investment back side of things, which has come off last year's highs or the year before, and you are hoping it's a trough for the investment banking market, as markets reopen, that side of your business will also start to kick in, and that can only take things to a higher level for these banks.
Read that investment banking side of the business. We've seen some layoffs. There's been some negative news. Have we gotten any signals about whether or not this is the end, we're done, that's going to be in the rearview mirror now?
Look, the favorite phrase for all investment bankers right around now seems to be green shoots. They're all hoping that capital markets are opening up, and that generally will mean that down the road you will have higher advisory fees, higher equity markets fees, higher equity capital markets, debt underwriting fees. But there is a note of caution there. As we look at the next couple of quarters, even if markets open up now, the advisory fee and the fee you make from doing stock raises and selling debt for completing mergers is kind of dependent on the deals that have already been announced. And M&A volume through the first half of the year has been down significantly. And the JP Morgan Chief Financial Officer, Jeremy Barnum, actually pointed out that that would be a headwind. But to the broader question of how should we look at it in terms of layoffs, will there be bigger job cuts going forward? It feels like it. And again, no one's willing to say no outright, but it feels like they have done the heavy lifting. And it really has to stay at a really subdued level, activity in the markets, that is, for them to have to consider further significant job cuts.
If you look at the KBW Bank Index, it's down about 18% this year. Just today, it's down about 2%. Obviously, an unprecedented underperformance when it comes to the S&P 500. But if you want to look at it from a valuation perspective, the KBW is actually trading roughly 9 times projected earnings for next year, about 19% below the average over the last half decade. So when it comes to shareholders and that type of a view from investors, what do you think they want to know more from the big banks, and have valuations gotten just cheap enough that maybe they'll step back in and potentially buy, because they haven't necessarily recovered quite as much from those lows when you think about what happened in March?
And I'd argue that if you look at the banks, if you look at all the members of that index, you can perhaps put them into 2 different neighborhoods.
Right.
Yes, the banking index is down 19%, but JP Morgan's up 11%.
You have the
this
big
year.
banks and then the regionals that are
Fargo's
also
up.
included in it.
Citigroup is up. Morgan Stanley's up. So it's almost like the biggest banks are cushioned from some of the hits. When you go one level below that, you still want certainty that customers are not fleeing towards the very biggest banks because of deposit concerns, because of what we saw in March. And you want to see that those banks that don't fall sort of in the strict regulatory moat of the biggest banks that do seem to be holding up well, can they withstand this environment where rates may very well remain higher for longer?
One interesting comment we got from JP Morgan CEO Jamie Dimon. They're dancing in the street. He was, of course, speaking about some of these non-bank rivals. The message there on the call, how much can these rivals expect to gain? Where do banks, traditional banks, lose business?
No, look, that's why we love hearing from Jamie Dimon on earnings days. He never holds back. Anything to do with regulations, anything to do with new constraints, he will speak his mind. And let's set the context here. Why he actually made that comment was a lot of the focus on the call was the new capital rules that could come out, a 20% increase in capital that banks may have to set aside because of the new requirements that will be put in place by regulators. JP Morgan's been very clear that is not going to be good for them, but more importantly, it might not even be good for the real economy. They will, of course, deal with it and do what needs to be done, and they keep bragging about the fortress balance sheet, so they should be in a good position to handle any outcome, but they're very clear that what you're going to do is move the availability of credit from the biggest banks to players in the private equity world, to hedge funds, to the private credit market. And that's when he went out with a and Jamie Dimon, who was calling in from Europe, we understand, for the call today, jumped in even while his CFO was speaking and very clearly said they will be dancing in the streets.
I don't know, though. I feel like as a hedge fund reporter, I used to hear this all the time from the banks, and the hedge was like, okay. Maybe.
We only have about 30 seconds left, but Bank of America, Morgan Stanley, Goldman next week. We also have regionals like PNC and Citizens Financial. Do you think we'll have the same sort of theme here from them or something different?
The one standout is going to be Goldman Sachs. They are going to present a very different picture than sort of the 20% return on equity you saw from JP Morgan, or even the 10% that you expect to see from Morgan Stanley. They've had a very challenging Q2. There are obviously trends that are affecting the entire industry, and there are some very Goldman-specific, unique issues that will lead to numbers being comparatively poor, and analysts are pretty much bracing for that.
Sri Natarajan, always a pleasure getting your insight on all things banks, especially on the kickstart of earnings season, and more banks coming up next week. So we really appreciate it. Bloomberg News Wall Street reporter Sri Natarajan. We'll have more coming up soon. This is Bloomberg. Now let's get some company news with Bloomberg's Steve Rappaport.
Hi, Jess. JP Morgan, Wells Fargo, and Citigroup all beating second quarter revenue estimates with the help of higher interest rates. More on that from Bloomberg's Abigail Doolittle. Shares of JP Morgan Chase currently up less than 1%. Wells Fargo up 0.8%. Citigroup, though, going the other way, down 2.7%. First, it was the writers, and now the Hollywood actors have gone off script in protest. Bloomberg's Steve Potisk reports.
For the first time in 6 decades, Hollywood writers and actors are on strike at the same time. The Screen Actors Guild walked off the job at midnight after failing to reach a new labor agreement with the Alliance of Motion Picture and Television Producers, which represents studios. While the Alliance says it offered double-digit pay hikes and higher pension and health benefits, the union says the sides remain far apart on compensation from streaming. In addition to walking off the set, actors will also have to stop attending film premieres, award shows, and other events.
Thanks, Steve. Now, Jess, I don't want to alarm you. Your binge watching can still continue because there are plenty of shows that are already in post-production. Those will not be affected, so that gives studios a little bit of buffer room.
Oh, that's great.
So whatever you were watching, whether it was Succession or
definitely.
Billions, so you're okay.
I'm okay.
It's
yeah,
all good.
Succession.
Sigh of relief. Yes.
I'm so sad the late night stuff is gone.
I know, it's tough, but hey, as long as we can still binge.
Anything you can recommend while we still have new shows?
Oh, that's a hard one. I've been watching Cruel Summer, actually. It's on Hulu.
All right, I'll have to check that one out. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We do have stocks off session highs, but still a 4-point gain right now, up 0.1% on the S&P 500 index. We are on track for a winning week. We've got the Dow up 125 points right now, higher by 0.4%. NASDAQ up 34, up by 0.2%. Bank earnings front and center today. Case in point, J.P. Morgan Chase up 0.3%. Citigroup lower by 2.8%. Wells Fargo higher now by just about 0.5%. Gains in the mega cap space also helping fuel today's advance. Nvidia hitting a record. Nvidia shares, they are advancing today. We do have Nvidia up by 2.2%. Microsoft also helping. It is up by 1.5%. Walgreens will be offering Perrigo's over-the-counter birth control Opill once it is commercially available. 10-year yield 3.81% with a 2-year 4.75%. Spot gold down 0.1%, $19.58 the ounce, and West Texas Intermediate crude down 1.5%, $75.71 a barrel. So again, recapping here, stocks are higher. Little change right now on the S&P, up by about 0.1%. The Dow up 0.3%. Nasdaq is advancing 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and Simone Foxman here, the Bloomberg Interactive Broker Studio. And we're going to switch things up again and talk about what's happening with problems when it comes to pensions, Simone. This is a really interesting story that's on the Bloomberg terminal. We're going to go up next and speak with Shruti Singh, who's a reporter with Bloomberg News covering Chicago finance. She joins us on Zoom to discuss her latest story on Chicago Mayor Brandon Johnson and how he's addressing the city's pension concerns. And looking at this, it's worst American city for pensions confronts a $35 billion crisis. Shruti, please speak to us and tell us about this story and the issues that are coming here when you're looking specifically at pensions.
So the city of Chicago has a very large pension burden, and it's been going on for a few decades now. It's been building slowly over the last couple of decades. And right now, where it stands in the most recently released numbers is that the net pension liability is about $35 billion. To put that in context, the annual budget for the city of Chicago is about $16 billion.
Well, what's interesting here is that Johnson's tried to promote these plans to raise more money, but they haven't necessarily met with much success, and there are concerns that you could see business continue to leave the city. Take us through the plans that have been proposed and where we might go from here.
So Mayor Johnson has only been in office for about 2 months. He was elected earlier this year, and he beat the incumbent, Lori Lightfoot. And so about 2 months in, he's taking a look at what solutions he may be able to come up with the state legislature and other parties that are involved, unions, employees, to figure out how to reduce this burden. It's a long-term burden, and during the campaign, he had talked about ways of raising about $800 million, and that could include a variety of measures that include taxes on airlines, taxes on the ultra-rich, taxes on a variety of different financial transactions, for example. But those are all proposals made during a campaign, and it's to be seen whether City Council and the state legislature would actually approve any of that.
One tactic you were writing about is how raising property taxes, which clearly would be a political lightning rod that you wrote about, and Johnson did pledge not to hike them during his campaign. How frustrated do you think Chicagoans are by that potential, if that could actually happen, and how likely would it actually come to fruition?
Well, property taxes are an emotional and complicated issue here in Chicago. And we've seen them increase from about $861 million, let's say in about 2014, 2015, to about $1.73 billion recently. And so they've increased quite a bit over the last less than a decade. And Chicagoans have felt that, and a lot of frustration about what's going on and how that affects their services. The interesting thing about property taxes is that while residents feel them on their bills immediately, 80% of property taxes actually go to pension costs. So they're not necessarily seeing them immediately in terms of what services they see on a day-to-day basis. Mayor Johnson, during the campaign, has said he did not want to increase property taxes anymore. There is already a CPI indexed increase built in that the former Mayor Lightfoot had put in, and it's to be seen whether that is going to continue on an annual basis or if it's going to be revoked.
Well, I know Johnson had campaigned in part because of the support, or on the back of the support he had from labor. What alternatives are they suggesting here?
Well, it's a complicated issue, and it's unclear exactly what the alternatives might be, but what the unions are proposing at this point, because there's a working group in place that is looking for measures that they can propose to the state legislature by October, which is when the state legislature comes back for what's called a veto session here in Illinois. And so right now it's unclear what is on the table, but in the past, things that have been on the table include things like taking a look at how salaries are calculated, the tenure in terms of how those calculations are made. So a variety of different questions about how annual cost of increases are calculated. But then there's also questions about whether there needs to be any broader reform beyond those technical measures. And then there's also questions about if there's a need for more revenue, what those revenue measures might be.
And when we talk about these annual payments, especially when you think about what's happening with Chicago's four systems that pay, when you're thinking about whether these are retired firefighters, police officers, municipal office workers, also laborers, what's the size and scope there as far as how much is going into that money?
Well, most recently, in the most recent year, the payment peaked at about $2.7 billion a year, and in 2024 that is expected to come down slightly to about $2.4 billion. Chicago's actually gone through what they call a ramp, which was a statutorily mandated increase in contributions, so they could play a little bit of catch up because there were so many years that the contributions had fallen behind. So the last, say, 5 to 6 years, they've been playing catch up, and that's cost the city a lot of money. But one of the things that people always point out to me is that pensions can seem very nebulous. You don't quite understand what's happening, but these are people who provide services in the community, whether it's police officers, firefighters. It could be somebody who is in the public works department. So these are services that function in a city and make a city run, right? And these are promises that the state courts have set precedent on, and the Illinois state constitution actually backs, according to what the courts have said.
Well, there were surpluses for the city overall that Johnson's predecessor, Lori Lightfoot, used to put some money into this pension liability. But it sounds like those surpluses may end soon. I mean, talk us through the city's overall financial health.
The city's financial health has been difficult for many years. They've faced what's called a structural balance for many years. And over the last few years, the previous administration, through the work that they've done, but also the federal stimulus that helped revenue recover, has been able to put some of the surplus towards advance payments towards the pension. But when you talk about these advance payments, we're talking about a few $100 million a year versus a pension liability, as I mentioned earlier, that's about $35 billion long term.
Something too, especially when you think about pension debt and some of the most dire consequences and circumstances there, a lot of people will automatically think about what happened when it came to Detroit, right? But then also, I thought it was interesting, you wrote about how there's a state law that doesn't allow Chicago to file for bankruptcy. So what do you think are the likely options and scenarios about when it comes to how this all ends up playing out?
Well, I'll certainly be paying close attention to that. Right. And I don't know exactly how to predict what's going to happen, but you're right that certainly pensions have impacted a lot of municipalities over the years, and the most dire situations have been circumstances like Detroit, which contributed to the bankruptcy I think it's almost 10 years to the day. And so certainly in the most dire situations, that's what's happened in the U.S. By state and federal law, Chicago doesn't qualify. It's not legally allowed to file for bankruptcy. There's always been questions like, oh, is that ever going to change? But, nobody can say what's going to happen in the future. But right now, Chicago is not one of those entities that's allowed to file for bankruptcy.
Shruti, just quickly before we go, business has not been involved necessarily in this working group that's been in place right now. We saw, I think the big headline from last year was Ken Griffin's Citadel moving its headquarters to Miami. I mean, are there other companies making this threat? And again, just quickly here, we only have about 30 seconds.
Yeah, so there's certainly been some high-profile departures from the city of Chicago, but what the city will also point out is that they've also had a lot of businesses expand in Chicago. Google, for example, is planning to turn a state building in the heart of Chicago into a hub for itself in the next few years. So the city of Chicago will counter with some of those anecdotes as well.
Well, Shruti Singh, reporter at Bloomberg News covering Chicago finance, thank you so much for walking us through the latest with your story. Really fascinating. And Simone, I know you're also looking at a headline that came through from the Wall Street Journal looking at how Binance is laying off over 1,000 employees.
Yeah, this has happened in recent weeks, according to the people familiar with the moves. It could result in Binance losing more than a third of its staff. So pretty enormous. We've seen tech layoffs, we've seen finance layoffs, and now we see crypto layoffs.
Especially just a massive crypto exchange too. So more of this all coming up when it comes to a lot of these cost-cutting efforts. Now let's head down to Washington, D.C. for world and national news with Bloomberg's own Nathan Hager.
Okay, Jess, thank you. It could be the break detectives have been waiting for in a string of murders on New York's Long Island. A suspect is due in court today in the deaths of 4 women whose remains were found in 2010 along Gilgo Beach. This is Suffolk County Police Commissioner Rodney Harrison.
Members assigned to the Gilgo Beach Task Force, which consisted of numerous detectives and investigators from the Suffolk County Police Department, as well as our partners in the FBI, did place one individual under arrest.
Commissioner Harrison did not name that individual, but the New York Post has identified him as Rex Heuermann, the founder of a Manhattan architecture firm. The Suffolk County DA's office will hold a news conference after that first court appearance. It's set for 4 p.m. Wall Street time. Back here in Washington, the House has narrowly passed a defense policy bill that comes with new bans on the Pentagon paying for abortion travel, transgender health care, and other social issues. The measure passed 219 to 210 with all but 4 Democrats against it. House Speaker Kevin McCarthy's message to them:
stop using taxpayer money to do their own wokeism. A military cannot defend themselves if you train them in woke. We don't want Disneyland to train our military.
Speaker McCarthy there. The Democratic-led Senate will consider its own version of the defense bill next week. President Biden has said he would look for more ways to relieve student debt after the Supreme Court rejected his plan last month. Well, the Education Department announced one this morning, $39 billion in forgiveness for about 800,000 borrowers who've made the equivalent of 20 or 25 years of payments. The NCAA has fined Tennessee more than $8 million and put out a scathing report on more than 200 infractions during former football coach Jeremy Pruitt's 3 years on the sidelines. Most involved recruiting infractions and tens of thousands of dollars in direct payments to athletes and their families. The Vols are avoiding a postseason ban. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. We do have stocks higher and on track for their best week since March. Traders are sifting through solid results from JP Morgan Chase, Wells Fargo, and Citigroup, which benefited from higher interest rates but easily beat lowered analyst estimates. As for the overall market backdrop, Stephen Auth is Chief Investment Officer at Federated Hermes.
And now what people are seeing is that, wait a minute here, maybe this, what we've called for over a year, a rocky landing, maybe the rocky landing is getting close to ending. And maybe, it's not going to end with a cataclysmic recession. I mean, how can you have a recession with corporate profits doing this well?
And right now we do have JP Morgan Chase shares up 0.2%. Citigroup is slumping 3.1%. Wells Fargo higher by 0.1%. S&P up 4. That is a gain of 0.1%. The Dow up 116, up 0.3. Nasdaq up 38, up by 0.3%. 10-year yield 3.81%. The 2-year 4.73%. Spot gold down 0.1%, $19.58 the ounce. And West Texas Intermediate crude down 1.7%. $75.59 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and Simone Foxman here once again in the Bloomberg Interactive Brokers studio. And I always love this segment, the C-suite conversations. It really gets into the nuts and bolts of, especially when you think about what's going on with the Fortune 500. So I want to get straight to our next guest, Tiger Tyagarajan, CEO of Genpact. That's ticker symbol G for our terminal users, who's joining us in studio on this Friday, which is very exciting. Always great to have someone in studio to discuss his company as well as AI's emergence. And I want to take a step back first, sort of show us the landscape of what your company does and who you work with, because I know you are working with a number of big Fortune 500 companies.
Great, thank you for having me here. And the way we would describe our company is a professional services firm that works with about 3/4 of the Fortune 500 companies. So think about a consumer goods company, a retailer, large banks, large insurance companies. And what we do for them is basically processing their finance, their procurement, their supply chain, the flow of information to make orders get delivered, to make inventory come down, to reduce cash flow requirements, to improve working capital, to reduce fraud and insurance claims. We process insurance claims. We process insurance applications. That's the work that we do, and we do it in a very consolidated way, which then allows us to bring technology to improve the way it gets done and deliver better outcomes.
So essentially the grunt work of doing a lot of
Well, we don't think it's grunt work.
Well, I mean, it means that somebody does not have to sit there and open their email.
That's right.
We've heard over the last earnings season, every time a CEO would say AI on an earnings call, it felt like, suddenly the shares would pop.
Even Kroger mentioned it 8 times, so not even just tech companies anymore.
I mean, talk to me about what you've been hearing when you've heard, these executives talk about AI. Are they talking about stuff that is going to meaningfully impact and change their business today, tomorrow, or perhaps in the next year?
So it's a great question, Simone. So the good news that for us is that not only do we listen to them when they come on to Bloomberg Radio and talk, but we actually meet them a lot because we serve them. And I would say clearly there is hype. So let's be clear. This is a hype. However, it's real. And the way I would think about it is that if you think about the cell phone and iPhone, if you think about the internet, those were hypes, but it did end up being real. So like any hype, in the short term, I think we are overestimating its impact. But in the medium term, and the medium term could not be more than a couple of years, we are maybe underestimating the impact, and that's what every conversation with these CEOs say.
When you're talking about overestimating the impact, from what perspective, as far as what about from a stock market perspective, when you've seen how much particular chip makers have moved on a lot of this hype, is that something that you think's been overdone, or do you think it's more not from that perspective, but from maybe even a more fundamental perspective?
Yeah, I'm assuming that the stock market moves less on short term and more on long term.
Obviously,
so therefore, it might actually be the right move because computing needs, therefore semiconductor needs, therefore power of all of that is the demand for that is certainly going to go up a lot. For our clients, it typically boils down to where's the biggest impact I can deliver and what do I need to make that happen. Clearly, large language models and AI models are very important, but guess what? You need data. And if you talk to typical large enterprises, that data is distributed, it's fragmented, it's corrupted, it's not clean. So there's a lot of effort that needs to bring that together to then be able to build and feed the algorithms that then deliver great value. And I think most CEOs understand that. However, they also know that once they get that together, then it's real value. It's improving their revenue, it's improving their customer satisfaction, it's improving their ability to serve their customers on time, in full.
Is most of the work that you're doing on the back end from the company perspective, or is any of this, is much of this, and how much are you seeing this increase on the consumer-facing end?
So, Simona, actually, interestingly, our business, about half of it faces the front of our clients' businesses. So if you think about a retailer, large retailers, placing an order for cheese or for chocolate, then how quickly can that order get delivered? Can that order be delivered not only quickly, but exactly the way it was ordered? And can you make sure that it gets delivered with a high degree of efficiency of delivery in terms of transportation costs, logistics? And oh, by the way, these days, can you actually make sure that you don't burn up too much carbon when you're moving trucks across? And how do you optimize all of that? How do you build algorithms and models that actually deliver that? Once you do that, the consumer goods company expects to be paid on time. So if you think about that whole cycle, that's all in the front end. When done well, everyone is thrilled. So this is about driving growth and customer satisfaction, because then that cheese is available when the consumer walks into the retailer.
I wanted to actually switch it up because I wanted to get your perspective on a key emerging market when it comes to India. That's something that we've discussed a lot on this program. What are your thoughts as far as just how big of a player that has been for a lot of especially big companies?
It's huge for us from a talent perspective. Let's start with that. More than 40% of our talent, close to 50% of our talent is based in India. And that goes back to the history of the company when we were part of GE, when we set up this operation as an extension of GE to serve global GE from India. Now we deliver those services from 35 countries across the globe. So India is incredibly important, but so are many other countries. The talent pool in India is incredibly important as we go into the future. The fact that you have a younger demographic, and when they come out, they are hungry to learn. And we are in a world where learning and reskilling is going to be the ticket to everyone's party. So we use that and leverage that for our clients, and our clients understand that. There is a different perspective about India being a market itself, and that demographic population creates a real opportunity. And the third one is how much can India becoming a manufacturer base to diversify out of just being focused on China?
We have about a minute here. We've seen this dramatic run-up in shares and things like NVIDIA, the demand for semiconductors. Right now it feels like an exuberance, but how significant do you think this will be, having more semiconductors, these input parts? Is the dramatic rally we've seen warranted?
So again, I'll give you a longer-term perspective, Simone, because I'm not here to predict and crystal ball for the short term.
Sure.
But
your best sense.
This is real. This is real. AI is real. AI will need computing power. AI will need data. AI will need change in organizations. AI will need reskilling of people. Anyone who's engaged in any of these topics is really going to create value for themselves, for their shareholders, for their customers. And actually, it'll improve society. The fact that you can have people leverage education and healthcare at almost zero cost, which is going to become real over time, is something to really look forward to.
Well, thank you so much for joining us. It's such a great perspective to get things on not just emerging markets, but then also about whether AI is just hype or if there's more to it here. So really great to get your perspective, as well as the Fortune 500 companies that you work with that have exposure toward AI. So that's Tiger Tyagarajan, CEO of Genpact. That's ticker symbol G for those using the terminal, who's in studio with us to discuss his company and AI's emergence. I just wanted to point out that if you're looking at what's happening with chip stocks today, ticker symbol SOX for the SOX Philadelphia Semiconductor Index, that's down about 0.4%. But if you want to look year to date, especially these names that have been driven by AI, that's up about 50% after losing more than a third of its value last year. We'll have more coming up. This is Bloomberg. Now let's get some company news with Bloomberg's Steve Rappaport.
JP Morgan, Citi, and Wells Fargo all posted better than expected revenue for the second quarter. But hold on, Bloomberg's Sonali Basak reports there are signs of bad news on the horizon.
That is worries still about commercial real estate. Goldman's earnings next week, according to Semaphore, is about to have $2 billion worth of write-downs tied to both green sky loans as well as commercial real estate. So we'll see some pictures there about what that could look like. Wells Fargo also raising its expectations for expenses, partially tied to severance, and Citigroup's expenses also coming in above line for expectations here.
Thanks, Shanali. Currently, we have JP Morgan Chase stock up less than 0.25%. Wells Fargo now down less than 0.5%, and Citigroup down more than 3%. Microsoft and Activision Blizzard are considering changes to their proposed merger to win approval in the UK. Bloomberg's Joan Doniger reports.
Steve, sources tell us Microsoft and Activision are considering giving up some control of their cloud gaming business to appease regulators ahead of Monday's deadline to seal the $69 billion deal. That could involve selling off the cloud market rights from games in the UK. The European Union approved what would be the largest merger in the video game industry, but US and UK regulators opposed the plan because of antitrust concerns.
Thanks, Joan. Shares of Microsoft and Activision are up. United Health boosted in the lower end of its 2023 profit forecast as quarterly earnings and revenue beat what Wall Street was expecting. The results were a relief to investors after Chief Financial Officer John Rex last month called out rising medical costs, particularly among the company's Medicare patients. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Jess Mitten and Simone Foxman here in the Bloomberg Interactive Brokers Studio doing a quick check on the markets, looking at the S&P 500, virtually unchanged, but still healthcare leading the way up more than 1%. You want to look at the bond market, though. The U.S. 10-year Treasury yield trading about 3.8%. And then if you want to look at what's happening with the crypto market, Bitcoin down more than 1%, trading still above the 31,000 threshold level there. But before we get into more with Bloomberg Markets, let's get the latest on world and national news with Dan Schwartzman.
Hi, Jess and Simone. A man has been taken into custody on New York's Long Island in connection with the Gilgo Beach murders. Rex Hoyerman will make his appearance in Suffolk County Criminal Court later today. Beginning back in December of 2010 till April of the next year, the bodies of 8 women, 1 man, and a toddler were discovered along a wooded stretch next to the beach. Suffolk County Executive Steve Ballone says they never stopped looking for the killer.
We have never stopped working on this case. There are police officers, Suffolk police officers, who started working on this case who have retired now. But their efforts, their dedication, it has never stopped.
Ladies, we're getting more details now as to who Rex Hoyerman is. He's a married father of 2. He's an architect living on Long Island while working in Manhattan. Police say advanced communication analytics were used to lead them to the suspect. The Biden administration says it will be forgiving $39 billion in student debt by updating a technical requirement under an existing program. Bloomberg's Amy Morris reports from Washington.
The change will help more than 804,000 borrowers. It comes as the Biden administration is looking for alternatives to a $400 billion student loan forgiveness plan that the Supreme Court struck down in June. This new plan counts more payments toward a forgiveness program that kicks in when borrowers have made the equivalent of either 20 or 25 years worth of payments. The Education Department says it will start notifying eligible borrowers today. In Washington, I'm Amy Morris, Bloomberg Radio.
Thanks, Amy. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg. Back to you, Jess and Simone.
Thanks, Dan. We appreciate it. Jess Mitten, Simone Foxman here in the Bloomberg Interactive Brokers Studio. And Simone, you were just talking to me about this story here on the terminal, looking about how crypto elation on SEC setback and rippling ruling overlooks these caveats. What are you seeing here?
Okay, so there's been a lawsuit that's kept the industry on edge since 2020 from the SEC against Ripple Labs. And the judge, yesterday, ruling that XRP token linked to Ripple was a security when sold directly into institutions, but not when offered to the public on exchanges. This causing the industry some degree of elation. But when you look at Ripple tokens today, they are down nearly 8%. And part of this is there are caveats here about how this overall will apply to the industry, and lots of still negative news, whether it's layoffs at Binance today or ongoing investigations, movements by regulators against the likes of Binance and beyond.
So this is a blow to the SEC?
Potentially. I think that the idea here is that there's overall long-term scrutiny by regulators that continues to ramp up. The purpose of these kinds of securities laws is to protect retail investors. The likes of Hillary Allen, a law professor at American University, says it's sort of inconsistent. And then, retail investors maybe should be the key beneficiaries of the SEC's oversight. So there's some weird stuff in here that's ultimately going to play out. And we've seen that pushback also by these regulators against, Bitcoin ETFs and the like that's really been dominant over the last couple of weeks.
Definitely. Tyler Winklevoss tweeting out how the Ripple ruling today confirms that the SEC and Gary Gensler are not the regulator of crypto. So I know people obviously know who Tyler Winklevoss is.
The regulator of crypto.
Right.
We shall see.
But looking at that, well, Simone, it's been a blast the last 3 hours being able to co-host to you. I wonder if Paul bothered to tune in and listen to us. I'm sure he's having fun
on the beach
at the Sweeney compound in New Jersey. We missed him, though. But looking at broader markets, still virtually unchanged, but up for the week. It's been a blast doing all of this, but we'll have more coming up. Sound On with Joe Matthews starts right now.
From
From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, cooling inflation has traders backing off on rate hike bets, even as Fed policymakers stay the course, all while credit spreads continue to grind tighter. We begin with the big issue. One and done?
We're done with the hikes.
Done after July.
It will be the last hike.
That's what I would do if I were them. One and done.
Take yes for an answer, Chair Powell, and let's stop with the rate increases. Done.
You please stop. every time Fed meets, we restaurateurs start sweating.
July is pretty much a done deal. It's what they do afterward.
We're moving to cuts.
The real question is what happens to the second hike.
The Fed is definitely determined to go a little bit further.
The Fed still thinks that they haven't done quite enough.
The idea that they're going to be cutting soon, I think, is a fool's errand.
When they start cutting, they're going to have to cut pretty aggressively.
You cannot get in the way right now of the soft landing narrative.
We're looking better in terms of a soft landing.
He could be the wizard of the economy in Wall Street if he can truly soft land this.
The jury should stay out on whether the Fed is done or not.
Joining us now, Subhadra Rajappa of SocGen and Morgan Stanley's Jim Karen. Great to have you both with us this week. And Jim, I want to start with you because we've seen one of the most aggressive rate hiking campaigns in modern history. Is July truly the end of the road?
I think it is. I'm not going to be very original in saying anything different. I think that at this point, this is the insurance hike, and that's the way that I look at it. I think that September is going to be a lot harder for them to make the case for a hike. We're already seeing inflation come down pretty decently, and these are the year-over-year base effects. So the inflation data that we got, to me, the way that I looked at it, it wasn't so much of a surprise to the downside. It was more of a relief. It was a relief that inflation is finally starting to do what everybody thinks that it should do. And I think Powell, at this point, can kind of step back and now let all those rate hikes that they've had in the past maybe do their work in the future and see if it can bring inflation lower.
Well, that seems to be the expectations in markets as well. If you look at swaps pricing, for example, a move beyond July, we saw the odds fall pretty sharply. But I want to bring you guys Fed Governor Chris Waller. Of course, he spoke yesterday. Seems like he's taking a pretty hawkish stance.
I see 2 more 25 basis point hikes in the target range over the 4 remaining meetings this year as necessary to keep inflation moving down towards our target. And I see no reason why the first of those 2 hikes should not occur at our meeting later this month.
And Subhadra, those comments came after we got June's inflation numbers, but Waller sticking to his guns there, saying 2 more hikes this year. How big of a risk do you see that actually happens and we're setting up for another markets against the Fed situation?
So I don't think another 25 basis point hike after the July meeting is really going to move the needle in a meaningful way. I mean, if you told me that the Fed is going to be following the Taylor rule and raising rates by 200 basis points from here on, then that's a meaningful move higher in yields. 25 basis points, in my view, is not really going to move the needle by a lot. The question is, the more the Fed hikes, I think the deeper the potential that the recession will be. Right now, I think the consensus view is for a soft landing. But if the Fed were to hike beyond 25 basis points and perhaps deliver more hikes after the July meeting, then that certainly increases the odds of perhaps a more deeper recession and perhaps a recession that's sooner than where most people have penciled in.
Well, it's interesting to hear you say that because there's been a lot of debate over the probability of a recession now, whether or not it even happens. And actually, we heard from JP Morgan's Bob Michael earlier. He's gearing up for some big moves in the global bond market, saying, quote, more and more indicators are at levels you only see in a recession. We are buying every backup in yields. The considerable central bank tightening is starting to bite hard in the real economy. And Subhadra, I mean, at this point, is a long duration call a recession call at this point?
So we've had a long duration call almost since the end of last year in October, given the fact that if the Fed is at or close to being done, the trade you want to be in ultimately is being long duration. And that's because of the fact that ultimately the market is going to look towards a recession or a meaningful slowdown in growth, and that should mean a decline in yield. So we have 3.25% penciled in for the end of the year. To me, the most important narrative for the next 6 to 8 months is how long the Fed keeps policy on hold. And that's really where I think a higher for longer metric makes sense. And in that sort of context, the decline in yields is probably going to be modest, getting to around only 3.25% by the end of the year, not really 3% or 2.5% intense.
Well, Jim, I want to get your thoughts on recessions, but let's stick to that point that Subhadra made, this idea of how long the Fed is going to be on hold, because the conversation really has been how many more times they're going to hike, but is the better question to ask how long they're going to stay at terminal?
I think it is. And the way that I look at recession right now is I'm just saying, bring it on. The sooner we have a recession, the shallower it will be. The longer it takes to have a recession, the deeper it's going to be, because that's where all the excesses build up and everything else like that. So, look, I'm not forecasting a recession by any means. But what I'm saying, though, is that if much of the consensus is correct that a recession starts in the fourth quarter, maybe the first quarter of next year, I think it's a mild recession. So, yeah, so it does seem like a higher for longer trajectory is there. But to Subhadra's point, if we do have a recession, the Fed is likely to cut. But now the question then is, well, by how much? Look at what yields are pricing. You've got a 5-year Treasury that's around 4%, a little above 4%. You've got a 10-year Treasury that's below 4%. So if the Fed policy rate is going to be at 5.5% in a couple of weeks' time, which we all expect that it will be, then how much are they going to cut? If they cut 50 basis points, 100 basis points, are those long-term yields going to stay at levels where we are right now? So I think the market's already pricing a lot of this in. Now, Subhadra probably has it right, that maybe there is a shot that the 10-year Treasury yield gets down to that 3.25% level. But I think we get there, and then we just bounce right back, and we go back up. So I'm not 100% sure how much protection the back end is giving us. I think for the initial reaction to potentially falling into recession, it's good. But then I think we need to risk manage after that.
Well, Jim, where on the curve does that leave you? Because if you look at the front end, I mean, you look at the moves in the 2-year yield, we were above 5% at this point. It feels like we're a long way away from that now. It really feels volatile everywhere you go.
So the sweet spot for me and what we've been doing in our portfolios is we've kept duration around the 3-year point. It's kind of like just a decent level where it's not so much the front end, it's not so much the back end. It's kind of a closer front end spot, which gives us enough duration that if there is a downturn in the economy and the Fed does cut rates, that you'll participate in that. But it also gives you the hedge that if it takes longer for the Fed to start cutting interest rates, that you're not giving up so much carry. Because remember, if you own the 5-year point, if you own the 10-year point, you're well below the Fed funds rate, which means that you would have been better off just holding the 3-month bill and just letting it roll over time. And that would be the concept of negative carry. So essentially, it's hard to time these things. And I guess that's my point. If you told me we were going to have a deep recession in October, starting in October, buy the 30-year long bond. But if you're saying, well, it might be, higher for longer and it might take some time and the Fed might go, gradually. And if they do cut, it's going to be, at some point in the future by 50 or 100, then I think the front end is like around that 3-year point. From my personal perspective and for our management in our risks and portfolios, that's a sweeter spot for me.
Well, of course, all of this really centers on what the Fed is going to do, and that depends on inflation. And Subhadra, obviously, we got some really good news on inflation this week from the June numbers, but this part of your note caught my eye. Buy 2-year tips. Walk us through that call. Why 2 years?
Because real yields have risen quite dramatically, and you're looking at a trajectory where realized inflation is probably going to be a lot higher than what the market anticipates or what the inflation swaps are pricing in. So break-evens have moved down quite dramatically because of the fact that we've seen commodity prices, oil prices come down. And 2-year real yields as well as 10-year real yields got to close to the highest level in a while. So it really makes a lot of sense at this point to be long real yields as a directional play for a normalization of real yields to lower levels. So we're looking at going long real yields. I think the most attractive spot is the 2-year, given our projections for where CPI is going to be for the next couple of years. But across the curve, I think real yields have sold off quite dramatically last year. They're starting to normalize. I think there's more room for real yields to decline from here on.
And Jim, I'll give you the last word here, because looking at real yields, it has been pretty amazing watching this rise up, depending where you are on the curve. We're looking at the highest levels since 2008, 2009. Do you see that as an entry point?
I do. I think Subhadra's got it exactly right. I think this is a place where I would argue that real yields tips will outperform nominals. Now, my personal view is that we are in an inflationary environment. So I think that inflation is going to average somewhere around 3%. In fact, I'll say over the next several years going forward, we're going to be in a 2 to 5% range. Doesn't mean that we can't get below 2 if we have a recession. It just means that we're not going to stay there. So I think Subhadra has it exactly right. Owning the real yields at this point, I think makes a decent amount of sense, and this is a good entry point.
All right, we're going to end on that harmonious note. Really enjoyed this, you guys. That is Subhadra Rajappa and Jim Caron. Thank you both so much. Up next is the auction block. Big bank earnings could jumpstart a wave of issuance. This is Real Yield on Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we're focusing just on the U.S. this week because fell short of estimates for investment-grade sales with just about $11 billion sold. You have the Yankee banks, such as RBC, continue to drive volume. Next week, though, we expect the big U.S. banks to take center stage. Now that earnings are underway, the group is expected to sell between $28 and $32 billion of new bonds. And over in U.S. high yield, we finally had a sale the 1st of July. Oil and gas support service firm Seadrill sold about $500 million. Meanwhile, Evan Brown of UBS says that the current environment is a solid one for the credit markets.
when you're buying high yield, you're buying it for the coupon. You're not buying it for much more spread compression. But the coupon is really attractive at 8.5% really on the high yield index all in. That's quite good, especially since we're not of that view that the economy falls off a cliff, and we are of the view that as the Fed slows down and approaches the end of its tightening cycle, that rate volatility can come down, and so that's positive as well. And so in general, this kind of not too hot, not too cold environment is a good one for credit. The spreads reflect that, but the carry is very attractive.
Amundi's Andrew Feltus and Matt Mish of UBS join us now. And Matt, I want to start with you because if I look at IG spreads at 120 and then high yield spreads at 380, it seems pretty tight. Is it really all about carry at this point, or could those spreads go even lower?
I mean, look, Katie, I think there's three scenarios: sticky inflation, there's a baseline view that we have of mild recession, and then there's soft landing. And I don't think the market, to answer your question, is fully priced for a soft landing. That would require, though, volatility, as Evan mentioned earlier, on the rate side to come down. You need equity volatility to stay low. We ultimately need some of the early optimism in the soft data to flow through into hard data and the growth picture to improve. But I would say IG, we think in a soft landing scenario, which is not our baseline, but in a soft landing scenario, can probably tighten another, call it 5 to 10 basis points. High yield, we think probably in that scenario runs another, call it 15 to 30 basis points.
And Matt, just quickly, what is the base case over at UBS then?
Yeah, I mean, we're still in the camp that we have three recession models where the modal outcome is a downturn, a mild recession in H2. I think, unfortunately for the market, people got too excited in calling for the turn, really starting middle and second half of last year. And so a lot of clients are once bitten, twice shy. But we ultimately think that the yield curve model, the hard data model that we run, is very consistent with a recession that's coming. We think the lagged tightening from credit tightening very clearly plays out about 4 to 6 quarters after the start. And as we all know, that started really in the third quarter of last year. And then combined with that, we do think, and I think ConAgra, and you're starting to hear it from a number of early earnings reports, that the consumer strength is fading or at least shifting. And so we think excess savings slows down and ultimately credit tightening hits the economy. We aren't overly negative in terms of our spread targets relative to a typical recession, but we're basically looking, for peak spreads about, call it 30 to 40 basis points wider in IG, and high yield essentially about 150 to 200 basis points wider from here.
Well, Andrew, come into this conversation. I want to get your thoughts on this dynamic in markets right now. Are you happy clipping coupons here? Or do you think that there's more juice left in the rally?
I'm actually closer to Matthew's view. We think there's going to be a recession in the second half, or maybe even the first quarter of next year. But the market's not pricing in. The market's pricing in a soft landing, and there's just no room for error. So if we do get that slowdown, and there's a lot of factors, we're in a Goldilocks scenario for the short term, but when we start seeing things like the yield curve, the savings rates, other things start hitting and slowing the economy, the market just has no room for increased amounts of defaults or deteriorating credit.
A no room for error market. I want to get a little bit existential here, Andrew, because this is a conversation I have all the time with the equity market. Is it more about macro conditions, or is it actually about the corporate fundamentals? When you look at the credit market, particularly the high yield market, what is this market actually being driven by?
Yeah, well, we don't see a bubble forming in any of the major parts of the economy. The consumer is really delevered over the last 15 years. Likewise, there's not a specific sector in the high yield market that's over-levered, been borrowing way too much money. So it should be relatively mild. I think the problem with the high yield market is the coupons are so low. Now, as those get refinanced, you go from 4, 5, 6 to 7, 8, 9. And that is when you'll start seeing strain into the market. And so it's not that we're going to have a huge spike in the short term in defaults, but you probably have a longer term recession as companies have to work through this dynamic.
And I want to talk about what this means if you add this all together in terms of total returns, because Matt, you put out a note earlier this week and you wrote that as long as the yield on 10-year treasuries slips to 3%, UBS sees investment grade offering total returns of 7%, high yield returning 4%. If you look at 10-year treasury yields right now, we're pretty far away from 3%. If we stay near these levels on 10-year yields, what does that mean for corporate credit returns?
I mean, if you stay here, I think two things, right? One is obviously they look a lot more like carry. You don't get that support from interest rates rallying. IG at 7% in particular is it's a call on really rate duration, right? If we have rates rallying 80 basis points, the duration's 8. That's driving 90% of that 7% total return. So you just get carry. Having said that, we still think IG in different scenarios looks pretty good. You are, from a yield standpoint, not coupon, but yield, you're getting just above 5%. U.S. high yield now, has performed very well in the last month to month and a half. And so you're just above 8%. So, is it really worth reaching for that extra 3% a year or 150 basis points over 6 months to own high yield when you can own IG? And even if you think, Andrew mentioned that the recession plays out, that's the right call, but it's delayed to the first half of next year, we still ultimately think that the combined return, we're looking for 7% till the end of the year in our scenario, which is that rates go to 3. The following year, we think returns are low to mid double digits. And again, that's high grade, high quality credit. And that's an environment where we do think the Fed's cutting next year. And it means that your money market or your savings account is no longer going to pay 4 to 5%. By the middle of next year, we think it's going to be closer to 3 or below 3. So, IG in a lot of different ways looks really good to us on a total return basis.
Andrew, come in on that, and I think that's a great point, Matt, that 5% that you're getting on cash, it's not going to last forever. And Andrew, when you think about total return expectations in the high yield market, have you had to downgrade those expectations as the year's gone on?
Well, because the market's been running, we've been having to bring them up. But we haven't really seen that slowdown hit yet, although defaults are creeping steadily higher. But the market is looking beyond that and assuming that we have this Goldilocks outcome. But we have not changed our view that we will ultimately end up in a recession. The question is going to be the timing. I think what's interesting about this scenario Matthew lays out is that if we are stronger for longer, that puts the Fed back in play. And so perversely, you could end up where you have a much higher probability of getting a September or later rate rise, even as we start seeing some of the things that have supported the economy so far run out. And that could potentially lead to a deeper recession sooner.
Andrew, 30 seconds. Against that backdrop, when you look at the sector level, where's the most opportunity?
I like tips. I think that's a great trade, just given where the carry is. Even if we look at the number in CPI, the core CPI is still over 5. It doesn't have the energy in it. And so that's really going to be supportive of inflation. At the same time, you have very attractive real yields in the tips market, particularly in that 2 to 5 year sector.
All right, we're going to end on tips. Guys, really appreciate your time today. That is Andrew Feltis and Matt Mish. Thank you so much. Still ahead, the final spread. The week ahead, more earnings on tap, including Bank of America and Goldman Sachs. That's next. This is Real Yield on Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure,
for something as universally important to human life as sleep. Mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up, lots more earnings on tap next week, including Bank of America and Morgan Stanley on Tuesday, Goldman Sachs, Tesla, and Netflix on Wednesday, regional banks, including Truist, on Thursday. We'll also get another round of jobless claims, plus existing home sales. Of course, though, it's going to be earnings that will be important to watch. After the financials, we get many interesting groups, including airlines, we get some social media, we get tech, and of course, we move on to some of those energy names. It's going to be a 10-day blitz, and we're going to take you through it. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Welcome to Bloomberg Markets. I'm John Olifman.
And I'm Matt Miller. Let's get a quick check on the markets right now. A little bit of a reversal on this Friday in terms of the Treasury trade. You do have very little movement on the S&P 500. It had been up more earlier. We're still over 4,500 on the benchmark index. But you see yields starting to rise again on Treasuries after the consumer confidence number came out much better than had been forecast and the best level that we've seen since the end of 2021. The Treasury 10-year yielding 3.8086. We're looking at the dollar coming back a little bit of a reversal there as well, although still holding down at about 1,202 for the Bloomberg Dollar Index right now after 5 days of gains. Today is the first decline in 6 sessions, and we see oil coming down as well. Right now, NYMEX crude off $1.46 to 75.43. So, John, a little bit of a turnaround to end the week.
And we've seen that in the financials as well, Matt, as we look at some of these individual players that have dominated the story today. Citigroup, for example, where their results were relatively strong on the credit side, but I think overall people are looking at it as a possibly mixed quarter. I mean, JP Morgan, very strong numbers. Generally speaking, you saw what was perceived as strong numbers from the Wall Street players. But again, this is a stock that's already trading around a 52-week high. As we go through the list with some other players in the financial sector that reported today, Wells Fargo, very much in the same boat as JP Morgan and Citigroup, with some overall headline numbers that got a thumbs up. I think there were some comments about the deposit picture for Wells Fargo going forward, which are maybe cooling some of the appetite for the stock at this hour. The one notable mover to the downside right now is State Street, Matt, and its own admission that it could have done better, perhaps resonating with investors who were really looking for some strong performance across the board here.
All right, John, let's stick with the big banks right now and bring in David Conrad. He is large cap U.S. bank equity research analyst over at KBW, and we really count on top-notch analysis of the banks from KBW. David, thanks so much for your time. What can you tell us about the banks, the big banks that reported today overall? What's the common thread in terms of the strength that we saw?
Yeah, Matt, thanks for having me. You know, it was definitely a mixed quarter. I mean, what we saw here was better than expected earnings. Revenue beats were across the board. I think the issue is the sustainability of the NII. We did get a couple NII upgrades for the year, but the sustainability heading into 2024 is a little bit challenging, and that's really to rising deposit costs. And so the quarters beat us this year because deposit costs didn't rise this quarter, because deposit costs didn't rise as much as we anticipated. But it sounds like for management, it's just a matter of slope, and we end up in the same place. So I think people are questioning the sustainability today.
As we get rising deposit costs, and as time goes on, David, don't consumers get used to higher rates and borrow more money at those rates? I mean, doesn't that help to boost the top side of the net interest margin?
Well, maybe a little bit. I think we're seeing a lot of growth in credit cards. So I think that's been one strong theme throughout the quarter. We've seen, almost 20% year-over-year growth in credit cards, to your point. So I think that's one asset class we would look to as a positive. But I think the asset side of the equation is getting close to being kind of done repricing. And we still have the consumer now really looking for yield on the deposit side. And so I think that's where we're expecting a little more NIM compression as we work through the year.
And David, at a time when a lot of people are still trying to figure out where the economy goes from here in certain sectors, and we talk about, for example, what's happening in the commercial real estate market, in terms of what these banks are saying about how much money they have to set aside for potentially bad loans, were there any takeaways from these results?
Well, Wells Fargo would be the one takeaway, and they did exactly what we thought they would do, and frankly hoped what they would do this quarter, and we're seeing some pretty decent relative outperformance in the shares. And so Wells Fargo has about 3% of its loan portfolio in office exposure, with maybe just under a third of that in California, which San Francisco is one of the more concerning markets, I guess. And what they did this quarter is they put up a large reserve against that, almost $1 billion excess reserve this quarter. And so we're more comforted by that, because now their reserve to office is almost 9%,
In our reports historically, we've looked at 9-10% as being kind of the stress loss in that market. So we think they've not necessarily put the issue behind them, but I think the reserve that they put up really helps address the issue going forward.
You mentioned the stocks. There's still plenty of uncertainties for the banking sector, but when I look at your target prices for names like JP Morgan and Wells Fargo, it looks like you see a little potential upside. Maybe not too much, but that you're not thinking that there's no upside for these names over the next 12 months.
Yeah, I mean, we're neutral for the group overall, and so we'd expect some outperformance out of Wells going forward. But what's happened recently is outperformance has been stability, and so some of these names have traded in a relatively narrow range, which have really been outperforming the BKX overall. And we kind of expect that to continue as we work through the quarter. But the numbers both for JP Morgan and Wells were above my expectations, and the guide was also supportive, so that will help as well.
Jane Fraser said Citi is still right-sizing the investment bank. I'm sure a lot of managers across the street are looking at who's doing well and who's not. What do you think we're going to see in terms of headcount this year?
Yeah, well, heading into next week with Morgan Stanley and Goldman Sachs, we're going to see some severance costs there as well. And so I think we are going to see some continued headcount reduction. But, keep in mind, headcount stayed up through the pandemic, right? And so there's some natural right sizing from there as well. But we did see, a pretty meaningful drop in investment banking. It was down 25% year over year for Citi. It was only down single digits for JP Morgan. So quite a bit of outperformance there. But what we are seeing is June was one of the stronger months of the quarter, and we're seeing announced M&A really start to pick up quarter over quarter, and ECM as well. So we're seeing some green shoots happening, which may limit the downside in terms of letting people go. But we do expect that to be a theme this quarter.
David, thanks so much for joining us. KBW research analyst David Conrad talking to us about the banks as they kick off really this earnings season, JP Morgan, Wells Fargo, and Citi. Now, in the crypto world, a federal judge ruled that Ripple Labs, their token, XRP, is a security when it was sold to institutional investors with a bunch of paperwork that is essentially a business plan, but is not a security when it was sold to the general public over exchanges. It's a decision widely hailed as a win for the SEC. Let's talk to the CEO of Ripple about it. Brad Garlinghouse joins us right now. Brad, I wonder what your reaction is, because it seems as though the judge was saying, when you sold this token XRP to institutions with paperwork that amounted essentially to a business plan, then it is a security. Although you could see it as a commodity, a way to play in the currency of your own blockchain, native blockchain, how do you react?
Well, let me back up for a second. The SEC brought 3 lawsuits. They brought a lawsuit against Chris Larson, the co-founder of Ripple. They brought a lawsuit against me, and they brought a lawsuit against Ripple. They lost the lawsuit against Chris Larson. They lost the lawsuit against me personally. And Ripple mostly won the case that they brought against Ripple. And so there's one narrow piece, and the SEC, in my judgment, and as certainly many are reacting, the SEC clearly lost as a matter of law. And the judge wrote, XRP is not a security, as a kind of intrinsic thing. In certain circumstances, which is kind of a narrow definition around institutional sales, it could be a security. So, look, the market reacted in a very positive way. Certainly, Team Ripple is very happy with the decision. And, Coinbase is up 25% yesterday. The value of XRP is up somewhere between 50 and 80%. So the market has reacted as a clear win, both for Ripple and for the industry.
All right, so what is going to be the result then for you as a result of that piece of the decision, Brad? And what is going to be the result for Ripple as regards to that piece of the decision from the judge who ruled that it is a security when looking at the institutional sales?
So the institutional sales ends up being, from the broad perspective, I don't want to say inconsequential, but it's the smallest piece. And I think in some ways it's ironic. The mission statement of the United States Securities and Exchange Commission is to protect investors. They went after Ripple, suggesting that, all kinds of things, everything we were doing was selling an unregistered security. And the judge really very clearly said, sales through exchanges, not a security. When it's used for compensation, not a security. When it's used for incentives around the overall XRP ecosystem, not a security. So, we have already moved a lot of our activity, and frankly, 95% of our customers are non-U.S. So a lot of our activity has been outside the U.S. jurisdiction because that's where our customer demand is. But I think that's where the U.S. is losing. And I think what the SEC has been trying to do is to put power and politics over what is really just sound policy and providing clear rules of the road such that entrepreneurs and investors can participate in this amazing new market around crypto and blockchain technologies.
Well, you raise an important point there about the fact that this is a globally connected crypto community, Brad. And while there was, given how all this was playing out, a delisting of XRP on platforms in the U.S., we saw a delisting, in markets like Canada as well. Can you just walk us through? We're hearing about relistings of XRP over the last 24 hours, but what the conversations with platforms are like for you right now?
Look, we actually, those are decisions made by the exchanges. But I mean, John, first of all, good to see you again. And it's when the lawsuit was first filed, a lot of the exchanges in the United States just said, look, we're going to wait and see what happens. And it's really because of the confusion that the SEC, in my judgment, had sowed in the market. They were increasing confusion in the market. And even as part of this lawsuit, the discovery process we saw is that they knew there was confusion, and they actually did things that they knew would increase confusion. And the only reason to do that is because this confusion actually masquerades as power to the SEC. But John, as you pointed out, just in the last 24 hours, all of the major U.S. exchanges, whether it's Bitstamp, Gemini, Kraken, Coinbase, have either relisted or publicly announced their intent to list XRP because there now is clarity. The clarity is XRP is not a security as judged by the United States. Of course, ironically, no other country on the planet thought that XRP was a security, but it's nice to have that clarity now for the market here in the United States.
So this is still a legal process playing out. I think people watching, an SEC appeal process, what that looks like. What does it mean for your company in your business in the interim?
Look, as a matter of law, the law of the land right now is that XRP is not a security. And until there is an opportunity for the SEC to file an appeal, which would take years, and frankly, we're very optimistic. If they were to file an appeal, we think that only further solidifies the decision this judge made. Because, look, as a matter of law, as a matter of the facts, and really as a matter of looking back in the history here, for the SEC, really it's overreach to suggest, as the chair has said many times, that basically everything in the crypto space is a security. Well, we now have a judge very clearly saying that is just not true, and very clearly saying XRP is not a security on exchanges and all these different use cases, which I think helps the whole industry for sure. So this is a win for Ripple. It's also a win for the entire crypto industry, and I think that's why you saw the crypto industry react so positively over the last 24 hours.
What is the most important use case, you think, Brad, for XRP? And do you feel limited at all in, publicizing use cases you're excited about, lest it be considered a security when you do that?
Well, the good news is, the answer to your question is that yesterday, before this lawsuit was resolved, or the decision came out yesterday, I would have said yes. I was worried about, evangelizing different use cases. I'm no longer worried because now there's clear rules of the road. The judge has made a determination, and that's the law of the land. Now, to the first part of your question, look, Ripple has really built our primary business. Our primary go-to-market has been around solving this cross-border payments problem. Today, and as I've certainly talked with John Ehrlichman about over the past, sending money overseas, even from the U.S. to Canada, can be slow, it's expensive, and it really has not kept up with modern technologies. Ripple is using XRP as part of our technology stack to dramatically increase the speed and dramatically reduce the cost of managing cross-border payments. That's how Ripple is using. There's interesting things going on in the real estate market around using blockchain technologies to reduce the friction of any financial transaction. These are the use cases. There's going to be a lot of them. I really feel like it's the earliest days of the internet where you couldn't even predict how these technologies would impact various businesses and various financial transactions.
And Brad, maybe talk to us about personally for you over this last day. You mentioned, you know, the lawsuit specifically with you, and you also mentioned the industry itself, or a victory for the industry. Have you been talking with your industry peers over the last 24 hours?
Look, I have heard from literally hundreds of people throughout the industry at all levels, and there's just broad enthusiasm and excitement that this is the first time the SEC has lost a crypto case. It's because I think the SEC's been a bully, and they've gone after weak players who couldn't mount a proper defense. Ripple had the fortitude, the courage to kind of go, and frankly, me individually and Chris Larson individually, to fight this fight. And I think many, many people in the industry are responding positively because the industry needed someone to fight, because the SEC was really just using regulation through enforcement as their primary tool. And that's not a good way to build a market. And the SEC still hasn't done the hard work that other countries have done, whether it's the UK or Europe, where they have provided clarity for rules of the road so that investors and entrepreneurs can build. And that's what has made American technology innovation so profound. Clear rules of the road. And even now the SEC is more focused on bringing lawsuits as opposed to doing the work. I will just conclude that thought with the good news is you're finally seeing in Congress, you saw a number of elected officials yesterday tweeting about the Ripple case and really calling on on Congress to pass laws so that there is the clarity that the SEC knows does not exist.
All right, Brad, really appreciate your time today. Thanks very much for making some time for us. Ripple CEO Brad Garlinghouse joining us. And on what Brad was just talking about, we're going to stay on that story. Actually, the Ripple news rippled through with Coinbase. That stock surging this week. And we'll get some insight and analysis from the former U.S. Senator Pat Toomey, who serves on Coinbase's advisory board, about what's happening in Washington. This is Bloomberg.
Change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture does. The OK is getting ready to make a decision.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our stock of the hour. Coinbase just got a big target price boost at Needham. The analyst there boosting the target price from $70 to $120. We just spoke with Ripple CEO Brad Garlinghouse about the federal court decision in Ripple's case with the SEC. He called it a big win for the crypto industry. That has created a more favorable outlook for Coinbase. Bloomberg's Sonali Basak joining us with more on this developing story. Sonali.
Absolutely. If you look at Coinbase, they got a big jump yesterday, about 25% just off of the back of this Ripple news. And if you take a look at the SEC, the Bloomberg Crypto, our colleagues over there call it the tainted 19. There are 19 tokens that the SEC across its lawsuits have targeted as securities that are tokens. These are native tokens tied to the likes of Algorand and Axie Infinity that they're talking about. But now there's some optimism that the tokens alone can't be named securities just for the sake of it. And it depends on how it's listed and sold and marketed as well. So a lot of questions still on the industry, but a lot of optimism that there's not a blanket rule that the SEC has to ensure all of these tokens will be considered listed securities.
Sonali, I want to bring in right now Pat Toomey, former U.S. Senator, of course, from Pennsylvania. He's also a member of the Global Advisory Council at Coinbase. And Senator, I mistakenly said earlier this Ripple decision was viewed as a win for the SEC, which is clearly the opposite of how it looks. In fact, regulators, not only the SEC, I think have a little bit of egg on their face from a couple of court decisions over the last few days. How do you view what we're seeing happen with United States regulators in court?
Well, I think this case with Ripple, the case in the Southern District, is devastating to the SEC. Some of us for 2 years now have been arguing that it's very unlikely that these tokens should be considered securities. And if you, the SEC, are going to insist that they are, at a minimum, you owe America a very clear rulemaking process and guidance as to how and why you come to that conclusion and what people should do about it. Well, Judge Torres comes along, and in a very thoughtful, very thorough, and very persuasive decision, she states clearly that XRP is not a security. And the logic and the principles that she applies and the facts in the case apply to a huge numbers of tokens. I would argue the vast majority of tokens, certainly everything that Coinbase trades. So if XRP is not a security, which I never thought it was, now you have a U.S. federal district court coming to the same conclusion. This completely eliminates the central thesis of the SEC that they ought to have regulatory authority in this space. They only get regulatory authority over securities. And we just have a very powerful decision stating that these tokens are not, in fact, securities. So this is a very good day for American consumers. It's a great day for developers. It starts to dissipate a very dark cloud that was chilling American development in this space. I understand it's not entirely dispositive. This is one case in one court, but it's very powerful.
Senator, I want to point out a tweet by Congressman Tom Emmer here, who talks about the Ripple case being a monumental development and establishing a token that is separate and distinct. But he now says, now let's make it law. When you look over at Congress and the lag there has been in rulemaking when it comes to the crypto industry, do you think any of this, all these SEC actions, empowers Congress to step up and make the rule of law faster so that this is all not just litigated in courts state by state?
Yeah, I think it does, actually. I think this probably creates a significant impetus for Congress. And it comes from multiple directions, right? So there are folks like me who believe that this is a very exciting technology and we ought to create well-defined guardrails that allow it to thrive while providing consumer protections. That category of members of Congress have always wanted a legislative framework. You have others who are more skeptical and want tight regulations. Well, under the logic of this case, they're not going to get that from the SEC because the SEC has no legal authority. They should want legislation as well. So you should now have a very broad spectrum of members of Congress who should acknowledge that providing a legal framework and followed by regulatory clarity, that's the way that you both allow innovation to thrive and protect consumers. So I do think there's going to be greater momentum for that.
Senator, Bloomberg Intelligence is actually trying to figure out how fast that momentum could play out, estimating a 40% chance of passage in the next 12 months. But, we do have this momentum building this week. Care to take a guess on how this process might play out with a framework from here?
But yeah, that's always tough. Crystal balls are hard to come by. And we should also remember that there are somewhat discrete issues that Congress might consider addressing separately. For instance, a regulatory regime for stablecoins. Stablecoins are a subset, obviously, of the crypto world. Relatively simple, easier to, I think, for Congress to wrap its brain around what's the right way to handle that. Then there's the issue that Judge Torres points out when a crypto token is used as part of a broader contractual obligation, such as maybe the initial funding of the development of a protocol, that can be a security. Well, Congress ought to define exactly under what circumstances it is. And then there's the issue of whether or not and how we ought to regulate the spot trading of these non-securities, these tokens that should be considered commodities. Is that the CFTC